I will highlight for you the areas that we intend to focus on in the coming fiscal year as we continue to mature the compliance and risk program and work through enhancements outlined in the multi-year plans that we have discussed at previous meetings. Our goal remains consistent with prior years to mature and strengthen CalPERS' ability to identify, manage, and mitigate compliance and ethics risks across the organization with a focus on people, processes, and technology. With regards to our focus on people, we continue to develop the skills and abilities of our in-house team so we can focus on building a stronger culture of risk awareness, compliance, and partnerships across the organization. As to our processes, we will continue to mature and formalize key compliance and risk management activities. And in technology, the team has made great strides over the last few years. We have completed the implementation of our compliance technology solution, enhanced reporting and other risk tools while leveraging software capabilities that we already had in-house. I am pleased to say that we now consider the technology track as closed and moved into business as usual. We will continue additional improvements and enhancements throughout the course of the project, throughout the course of the program, but we will not have any formal projects going forward on technology. On slide 3, you'll see our updated roadmap outlining our strategic focus over this past fiscal year and heading into 26-27. We continue to advance compliance and risk management across the organization through improved collaboration and training. With the completion of our technology build, most of our efforts and future years will be geared towards building the compliance and risk processes to strengthen program management, governance, and oversight. Through this approach across people, process, and technology, we will have built and continue to enhance and expand a strong foundation for continued success. As we move to slide 4, and as we've highlighted in prior reports, these are multi-year initiatives that will evolve as we build our program. Initiative 1 is focused on assessing and reporting risk. The 2 primary efforts for next fiscal year will include continuing to strategically roll out and integrate the risk and control self-assessment process across additional program areas. This will help ensure that risks are consistently identified, assessed, and managed at the source. And second, we are piloting a regulatory change management framework by partnering with program areas to identify opportunities to integrate existing regulatory change practices into the framework, ensuring key compliance and risk management considerations are incorporated. On the next slide, we have Initiative 2, which is minimizing risk by enhancing our assurance, monitoring, and issues remediation capabilities. Our key focus areas for the coming year will include strengthening the 3 lines of defense governance practices of our conflicts of interest management program, including the establishment of a conflicts of interest policy. In addition, we will be strengthening our partnerships with programs to enhance incidents and issues management by providing them with tools, resources, and education and advice to further equip team members. Finally, as we move to slide 6, this covers Initiative 3, Educate and Cultivate an Ethical and Risk Intelligent Practice and Culture. We will continue to build and deliver training to support team members' compliance and risk awareness across the organization. A good example includes our efforts to work on the CalPERS Code of Conduct training to include some of CalPERS' more specific and key rules. In addition, we will be engaging with the first line of defense at the program level, and we have a program called the Compliance and Risk Liaisons, which we also refer to them as CARLs. We will be providing them with more tools, training, and clarify roles and responsibilities. And we have laid the groundwork for a more structured policy management and governance framework, and will continue our efforts to effectively engage all program areas in this effort. That brings me to the end of our overview of the compliance and risk management initiatives for fiscal year 26-27, and I'm happy to answer any questions.
Okay, before we go to questions, I understand that Dr. Willis has joined us, so because we're not all present in the same room, and Dr. Willis will be participating from remote locations not accessible to the public. Bagley Keene requires the remote board member to make certain disclosures about any other persons present with them during open session. Accordingly, I'll ask Dr. Willis to attest either that you are alone or if there are 1 or more persons present with you who are at least 18 years old, the nature of their relationship to each person. Dr. Willis, do you so attest?
Yes, good morning, board members, and I attest to the fact that I am alone. Thank you.
Good morning, thank you. Okay, I just, I don't know if this is so much a question or a comment. I know we, congratulations to the team and all the hard work wrapping up the technology track. I'm just wondering, going forward, this whole burgeoning AI world that we're in now, it seems that as tools, it provides us potentially a lot of benefit, but also it seems like something that could really increase the pace of change with both the internal challenges and particularly with external threat actors. Just as it could potentially enhance our capabilities, it could potentially enhance the bad actors' capabilities. Any thoughts on that, and whether it's something we'll need to be revisiting sooner than later?
Yeah, that's a great question, and it's something that we've already been having some discussions with Prashant about, since he is kind of bringing in new perspectives, and also something talking with our information security office. So yeah, certainly something that is at our forefront of our minds.
Yeah, I just added something, not just across this vertical, but across the entire organization that we're thinking very deeply on. As you acknowledge, it's a very fast-moving area, and it touches both our capacities to sort of do the work of the organization, but as new models and new frameworks come out, also increases the surface area of threats to our data and other play in other sort of parts of the organization. So it's something we talk about on a near daily basis, and are sort of bringing in outside experts and increasing our internal capacities in real time.
Great, thank you. I'm not seeing any other questions or requests to speak, so I thank you for the report and the work of everyone on the team.
Thank you.
I have a public comment on this item before we go to it's an action item. So for 5A, I have Mr. Jelensik.
Good morning again. J.J. Jelensik, RPEA. The presentation describes the annual goals. It does not provide insight into what actions your staff is actually going to take to achieve those goals. A plan with no action steps is unlikely to achieve its goals. The lack of actual measurable actions means there is no accountability, no way to measure success, no way to provide meaningful oversight and monitoring. I would encourage the committee to reject this so-called plan and direct staff to come back with a real action plan and not just hopes and wishes. I know they can do it. I will also point out that these comments also apply to 5B, the Office of Audit Services plan. I can come back and repeat them, or you can just consider them twice, because I know you're paying a lot of attention, and I thank you for your consideration.
And there it is. And this is an action item, so pleasure of the committee. Moved by Mr. Palkey. Seconded by Mr. Johnson. Okay. So any discussion of the matter? Okay, I'll call for the question. We have to do a roll call.
Michael DeToy. Aye. Deborah Gallegos from Malia Cohen. Troy Johnson.
Aye.
Lisa Middleton.
Aye.
Kevin Pauke.
Aye.
Melissa Willett.
All right, the motion passes. That moves us to item 5B, Office of Audit Services Plan.
Good morning, Mr. Chair, members of the committee. Belize Chapuis, Office of Audit Services. Agenda item 5B is an action item. Staff requests the Risk and Audit Committee to approve the Office of Audit Services proposed audit plan for the fiscal year 26-27. As required by the internal auditing standards, the Office of Audit Services prepared the risk-based audit plan to determine the priorities of the internal audit activity for the next fiscal year. In conducting the risk assessment, the Office of Audit Services, as the third line of defense, coordinated its efforts with the second line of defense, the enterprise compliance, risk, and governance. We interviewed CalPERS executive and senior management teams and sought input from the board members through surveys. In identifying the internal audit assignments and activities, staff evaluated multiple risk factors, such as the organization's strategic goals, concerns raised by CalPERS management and the board, information from prior audits, coverage provided by other assurance functions. For the employer compliance reviews, the Office of Audit Services plans to complete 4 review cycles, covering 1 compliance area per cycle. Using data analytics, staff will identify agencies for review for each cycle. As required by the internal auditing standards, we'll remain responsive to the changes in the organization's operations and programs, and we will review and update the audit plan as necessary. Any modification to the audit plan will be communicated to the committee through the quarterly status reports. This concludes my presentation, and I'm happy to answer any questions.
Okay, any questions? Not seeing any questions. I thank you for the report, and this is an action item. I will note that Mr. Jelensik's comments that 5A also apply to 5B and I assume 5C as well. So it's a pleasure of the committee. Moved by Mr. Palkey. Seconded by Mr. Johnson. Any discussion on the matter? No discussion. I'll call for the question.
Michael DeToy. Aye. Deborah Gallegos. Aye. Troy Johnson.
Aye.
Lisa Middleton. Aye. Kevin Palkey. Aye. Melissa Willett.
Yes.
All right, the ayes have it. The motion passes. That brings us to action agenda item 5C, the Independent Auditor's Annual Plan.
Good morning, Mr. Chair, members of the committee, Belize Chapoy, Office of Audit Services again. Agenda item 5C is an action item. Staff requests the Risk and Audit Committee to approve the board's independent auditor, Plant Moran's, audit plan to audit CalPERS' financial statements for the fiscal year ending June 30, 2026. The presentation will allow the Risk and Audit Committee to hear from the independent auditor regarding their approach, objectives, scope, and deliverables for the financial statement audit. Plant Moran staff are presenting with me today, and I would like to turn it over to them.
Good morning, everyone. So we're here to provide an overview of the audit plan for 26. If you could move to the next slide, it's just an agenda. We intend to cover the pre-audit communication and end with some, oh, pardon me? Oh, I'm sorry. I'm Jean Young, the lead partner on the account for CalPERS. And again, we intend to provide an overview, and with me is Amanda Kronk, the principal on the engagement, and Michelle Waterworth, our technical leader. If you want to move to slide 5, please. So the audits that we're here to perform are the financial statement audit, the GASB 68 and 75 schedules, and then the attest on the census related to the agent multi-employer plan. In addition to those financial statement audits that we'll be providing, we also will have other deliverables on the internal control over financial reporting and compliance as required by the governmental auditing standards, our required communication at the end to the Risk and the Audit Committee, and then a management letter if needed. The next slide highlights our timing. We actually started in March of 26. We've been having meetings and discussions. We are on site in May to start our walkthrough process and understanding of the internal controls, and intend to wrap that up this month. And then the rest is just our plan going forward. Next slide. With any audit, the auditor responsibilities are to gain an understanding of the internal controls, but not provide an opinion on those. It's really for us to design appropriate procedures, to express an opinion on the financial statements, and then again, under the GAO standards, we're expected to design audit procedures to detect instances of noncompliance related to financial reporting. Also, we will report communications regarding any deficiencies that come to our attention that are required to be disclosed, such as material weaknesses or significant deficiencies. The next slide, continuing with the auditor responsibilities, we will report on the amounts in the financials that are management estimates, more significant estimates, which Amanda is going to cover in more detail. And then to conduct the audit in a responsibility not to relieve management of their responsibilities, but to do the testing under the audit procedures. And then lastly, we obviously need to maintain our independence under the professional standards related to this process. With that, I'll turn it over to Amanda.
Thanks, Jean. This slide here covers a couple key elements to our audit, and the first of which is the internal control structure. Jean briefly mentioned that our goal and part of our audit procedures are to gain an understanding of the processes and controls here at CalPERS to ensure that our audit procedures are designed accordingly. That process is much more complex than I just made it sound. And in this first year, we've really started with the narratives that your team has in place. We then have coupled that with a number of inquiries to ensure that we have a full picture of the processes and controls, at which point we then will walk through the key, those key processes and controls. As Jean mentioned, we do not and will not opine on the effectiveness of those internal controls, but again, it certainly helps us, A, indicate whether they're operating as intended, but B, really helps us design the rest of our audit procedures. In keeping with designing the rest of those audit procedures, we do adhere to the concept of materiality. And this is not a new concept. I'm sure you've heard it in the past, but it really does help guide us to A, what are significant transactions and maybe areas that we need to place a greater emphasis on, but also helps us identify maybe unusual transactions or new transactions to CalPERS that we also need to place a greater emphasis on. On the next slide, we're going to take a look at some significant risk items. And I'd like to preface this by saying the risk assessment phase of the audit really is occurring throughout the entire audit process. So we are here today and we'll walk through the risks and estimates that we've identified to date. But just know that as we continue to not only plan, but work through our final year-end fieldwork, should anything arise that does require communication to you, we will do so at that time. So the items on this slide are a mixture of not only significant risks that the auditing standards have indicated are present for every single audit, but also risks that are very specific to CalPERS. The first of which on this slide is management override of internal controls. And it is exactly what it sounds like. So part of our audit procedures will be designed to identify any controls that are more susceptible to management either working around that control or simply overriding it. So certainly a risk to the financial reporting process. The second bullet here focuses on valuation of investments. This is strictly due to the sheer size of the investments that you hold, particularly related to those that are valued using unobservable inputs or your level 3 investments, or those valued at net asset value. So we'll get in on the next slide to how we'll test those. Improper revenue recognition. So this is another item that audit standards say are present in every audit. Particularly for CalPERS, we will focus on premiums in the healthcare plan and long-term care fund and how those are recorded, along with investment gains and losses. Again, particularly on those harder to value investments. Total pension and OPEB liabilities are considered a significant estimate that management makes through the use of actuarial experts, and part of our procedures will be to not only test the inputs that are used in calculating those liabilities, but also the assumptions that are made. Lastly, on this slide, the valuation of the estimated future policy liability that is in the long-term care fund. And we will get into our testing of that in the next couple of slides. So as you can imagine, we've identified these risks, and we certainly on the next two slides want to walk through how we're going to test them. So on the next slide, we'll begin with management override of internal controls. We've designed our audit testing to focus on a couple different areas. Number one, journal entry testing. So we will get a download of manual entries that are posted in the system, and then we use data analytics to target certain risk areas. So we will do that, and then from there, we'll select a sample of journal entries to make sure that they're appropriately supported and valid entries in the system. We've also, when we were here for interim, worked through various fraud discussions, which again are required by auditing standards, but those inquiries also help us align and develop our audit procedures as it relates to certain risks of fraud. Valuation of investments, as I mentioned, is certainly a big target area for our audit team. And we gave you a brief snapshot here of the testing in this particular area. So the first bullet, understanding of the controls. So we do that in order to perform control testing over those controls. So we will identify the key controls in place that reduce the risk that those valuations are incorrect, and we will control test those certain controls. We also perform data analytics, and we're looking for key risk areas as it relates to those level 3 and net asset value investments. And we're looking for things such as new investments or significant fluctuations that may not be expected based on market trends. And we utilize that to select the investments for substantive testing, at which point we'll look at management's lag analysis, expert involvement. So for those level 3 investments that don't have readily available audited financial statements, we will involve our investment experts to provide assistance in reviewing the assumptions and inputs into those estimates. And then again, for those valued at net asset value, we'll be obtaining and reviewing the audited financial statements and related capital statements. As I previously mentioned, improper revenue recognition is a risk here as well, and we dovetail that testing in with our substantive testing of those alternative investments. The last section here is related to the improper revenue recognition of premiums, and this is really, this testing will be focused on the premiums and recording of the federal government subsidies. And to do that, we will select a sample for testing. We will get the supporting documentation, ensure that that is all vouched to the cash receipts. And then we will also be testing and recomputing the unearned premiums in the healthcare fund. The next slide focuses on the total pension and OPEB liabilities. There are a number of contributing tests in this area that we do. We start with focusing on the key census data attributes or the demographic key points in the census data. We do a number of analytics there to look for anomalies. Maybe it's, somebody had 5 years, added 5 years of service as opposed to 1 and things of that nature. We also are performing testing at the employers. So we've selected a sample of employers for testing, and we will be ensuring that the data that they've provided is accurate and complete. Again, I've mentioned the analytical tests. We also will select samples for substantive testing. And last but certainly not least, we will be reviewing the actuarial valuations, testing and ensuring that those key assumptions are reasonable, not only for CalPERS and the data used, but certainly compared to other market assumptions. The last section on this slide is focused on that future policy liability in the long-term care fund. I would say similarly to the pension and OPEB liabilities, we'll be reviewing the data used to develop that estimate, ensuring that the assumptions used are reasonable, and we will do so through our on-staff actuarial specialists, along with the tools that management has utilized to develop that liability. On the next slide, you might be thinking that was a lot of audit talk, but there's also a lot more to CalPERS than just those areas, and we agree with that. So just because we may not have a specific risk or estimate associated with an audit cycle doesn't mean that we won't be addressing it. So this slide just highlights a couple of other key and large audit sections for you. Contributions, certainly key. Contributions coming in from the employers and ensuring that those are reflected appropriately. Benefit payments going out, whether it be to participants or the employers in the case of OPEB. We will be selecting samples and performing analytics and things of that nature. The healthcare estimated insurance claim payable, or the IBNR, that is an estimate, and we will be reviewing it and testing it as such. So again, what were the inputs utilized and are those reasonable? And then looking at administrative fee revenues and expenses. With that, Michelle is going to give you a highlight of accounting standard changes.
Good morning, everyone. As Jean mentioned, my name is Michelle Waterworth, and I'm going to wrap up our presentation by just sharing with you some of the things that we're going to be looking for this year in terms of the accounting standard changes, and a preview of what's to come for you for next year in that same vein. So if you look at slide 15, this just gives you a very high level. We only have 2 standards that will impact this year. And fortunately, those standards were going to have a fairly minor impact on CalPERS. And one thing that's notable with both of these standards, they impact only disclosure. A lot of times when the Governmental Accounting Standards Board puts forth pronouncements, they impact both the accounting, so your financial statements, as well as disclosure. These 2 particular pronouncements for every organization only impacts the disclosure. And here again for CalPERS, the impact on the disclosures, because of the nature of your entity for these 2 standards, is fairly minor. So I'm going to go through them fairly quickly. On the next slide, slide 16, I want to talk about the first standard, and this is a standard that CalPERS is implementing this year. It deals with the financial reporting model, and really, again, because it's disclosure only, it's going to have 2 particular impacts specific to CalPERS. First of all, you have a section in your financial statement called the Management Discussion and Analysis. This particular pronouncement that GASB put forth basically emphasizes the importance in the MD&A of really telling users what happened during the year. The goal is a user could just look at your MD&A and come away with an understanding, a really good understanding of what happened within the organization this year. So there are 5 basic sections that GASB prescribes to the MD&A, somewhat similar to what you've already been seeing in your financial statements. But again, GASB is emphasizing really to tell the reader what happened. Why did changes occur during the organization, and in particular within the financial statements? The second impact will be on your proprietary funds. There is a slight change in the format of those proprietary funds. Again, it will have a very minor impact on CalPERS. And again, this is a standard that you'll be implementing for June 30th, 26, so for this year. And then the second standard that CalPERS is implementing this year has to do with, again, disclosure only, and it has to do with capital assets. And because capital assets out here are very, very, very minor in the scheme of your other financial statement numbers, this particular pronouncement, which requires some changes in the disclosures, is really not going to be impactful. So that's great news. And then on the last slide, this particular pronouncement will impact CalPERS next year. And this deals with GASB's really revision to the definition of subsequent events. So GASB looked at really a population of financial reports and determined that a very high number of governments really aren't under current standards today. They're really not disclosing subsequent events the way they need to. So GASB decided to revise the standard. So this standard does two things. It changes the definition of subsequent events, and it will require a new footnote in your financial statements. And that footnote has to display the date through which subsequent events were evaluated. So again, in the scheme of things, it's disclosure only, and it will have a very minor impact on you. But again, that's a change for next year. And with that, we are happy to take any questions or comments that you have for us today.
Okay, we have several questions. I'll start with Director Willett.
Thank you. Thank you for the presentation. Welcome to CalPERS. I just want to follow up first on the significant risks you flagged around valuation of investments without observable inputs. And I think, if I understand correctly, that's mostly our private equity, private debt, and real estate holdings. And when there's no public market price to check against, given how much of our long-term returns depend on those valuations being right, when you're testing the valuations, what are you using? What are you testing? And does it cross-reference, or do you calculate in like workforce metrics, or is it just a financial evaluation from the company?
Great question. So I'll start. So there's really two avenues that we will work down. So first, we'll go with the easier avenue. So for those that are valued using what's referred to as net asset value, our process starts with management's process, which is to utilize the March 31st valuation and roll it forward to June 30th. So we start there. We will obtain the audited financial statement that private equity or private debt investment issues. We will ensure that the capital statements that CalPERS is getting are accurate using that audited financial statement. And then certainly we will test the roll forward process. Now, what we will also do is if that June 30th, 2026 capital statement becomes available before we issue the audit opinion, we will also evaluate that audit evidence to ensure, again, to your point, were any gains and losses significant that needed to be recorded as of June 30th. And we also test management's process of reviewing those June 30th capital statements as well, to ensure that we have an understanding of how many were received and how many have yet to be received for those private equity and private debt investments. Now, the other avenue where perhaps audited financial statements are not readily available, which we most commonly see with the real estate investments or the real assets, we will work with our internal real estate investment professionals and to ensure, so we do a couple of things in this area. We will obtain what that investment's holdings are and what the inputs utilized into their evaluation are. And we will ensure that our experts think that those inputs are reasonable, such as, occupancy rates and things of that nature. We will also obtain and review appraisals if those are available, again, with our experts reviewing those appraisals to ensure that the inputs and assumptions used are reasonable. I don't know if Jean and Michelle have anything to add.
Yeah, on those level 3 investments where there are unobservable inputs, as Amanda mentioned, we are looking at the significant inputs and assumptions that go along with those valuations. And we do pull in our valuation specialists into the process. They have lots of data on comparable company multiples. That also is something that they look at and compare your assumptions against.
All right, thank you. Just to make a comment, having worked at the assessor's office for 10 years, I feel sometimes those real estate appraisals are more an art than a science. So it is make me, independent appraisals would be really valuable in that sense. And then just more broadly though, as we're looking through these risk areas, I'm thinking about how they translate into what it means for our employers, right? What it means for employers and ultimately our members and the rates that they contribute. So of the 5 significant risk areas identified, which one do you think carries the greatest risk of a finding that would affect employer contribution rates and a risk that's changed materially from last year's plan, if any?
I'll start. I think investment valuation. So if your investment valuations are, I'll say perhaps misstated, I think that can translate into future changes to employer contributions, right? Whether to the positive or the negative. But my vote, I guess, if we're voting here, would be investment valuation.
I would agree. That is the highest risk. And again, all of these are significant risks that we have to consider. But investments, obviously, if they're not on the public market, they're harder to value, which again, we want to understand the controls, to understand what management does to come up with that valuation, and then do our own independent evaluation of that valuation and work with our experts. So again, if there's an industry issue or something's going on, just considering that.
Thank you. That's my questions.
Okay, next I have Director Gallegos.
Thank you, and welcome. Going back to a conversation that we had a little bit earlier, to what extent do you utilize AI? How does that help you facilitate such a massive audit process? And yeah, if you could just explain how you envision using that with our process.
So for AI, we have some tools that we use for the data analytics, but that's not really using AI. We're really comparing like we'll take all the census and compare it to the previous year, and what we're looking for are outliers, as Amanda referred to. If someone should have 1 more year of service, their birth date should not change. This should pop out the outliers, and then we look at them. We do use AI potentially for some research and memos and such, but we do keep protected client data is not going through the AI. That's just a risk that we're not taking as a firm at this point. So again, we can use it for informational, but we have a lot of data analytics that we use that are more precise software that we can use and test that census data.
And just to clarify, I wasn't asking in the context of risk, although there are risks, but more facilitation and how you can speed up or help you broaden your ability to audit using AI.
A couple other areas that I will say we've had great success using AI is contract review. So I think we can all appreciate how lengthy some contracts get. So utilizing AI to pull out the key elements of those contracts. Also summarization of minutes. And there's a lot of minutes and sometimes there's a lot of committees and things of that nature. So pulling out significant audit items, AI has helped us do that as well.
Great. Thank you.
Okay, next I have Director Middleton.
All right, thank you. And thank you and welcome, and we appreciate the role that you play. So my questions are much more an overview of the audit process itself. And first I want to get across, has anyone placed any restrictions on your access to any data that you seek?
No, we haven't had any restrictions.
Okay. And you would report to us if that were to occur?
Correct.
Thank you. How many auditors are going to be involved in this audit? How many are going to be working full-time on it, part-time, and for how long?
Great question. So we've built our audit team. It's 50 to 55 individuals. I don't have the exact number of full-time to part-time, but that includes our actuarial team members. That includes our partners, our principals, all the way down to our staff. So if I had to guess, I would say 25 would be full-time, 25 to 30 would be full-time. And then certainly our investment experts and our actuarial staff would be part-time.
Okay.
The audit process too, by the way, just to clarify, our year-end field work is estimated to begin August 10th and will run through issuance.
And your issuance is expected approximately when?
November, let me grab the timeline.
Middle of November.
Yeah, middle of November.
Okay, very good. All right.
Yeah, maybe to add to that, so we were out here doing control testing and walkthroughs in May. So we had about 10 people one week and 10 people the next week. Our IT people were out here understanding that system too. So as Amanda said, we have 50 people set aside to work on this. We kind of have it divided by what cycles and sections they'll work on, but they're all Plant Moran staff. There's no part-time people or anyone that we hired. These are all existing staff with the experience with PERS and governmentals.
Do you have an estimate of the total number of hours of audit time that will be involved in this?
Go ahead. We had estimated around 10,000 hours, a bit more, just again, the first year gaining that understanding and going through the information. So we would expect the first year to be higher. But based on our proposal, it was about 10,000 hours.
Okay. So comment, this strikes me as very appropriate, very necessary, and I'm satisfied that the staffing levels are appropriate for what you're taking on. Thank you.
Thank you.
Okay, I'm not seeing any other requests to speak, and I will just comment that, I've been pretty much following fairly closely this transition, and I think both your team and our internal team have done a phenomenal job of getting things up to speed. Everyone's kind of hit the ground running. I think the priorities that you've outlined are right on target with our priorities, and so I just look forward to continued progress, and we'll just stay in touch, and the committee will be very open to any issues that come up as they come along. Great, thank you.
Thank you.
So this is an action item. I don't have any requests to speak on this one, so it's a pleasure of the committee. Moved by, okay, moved and seconded. So I will, not seeing any requests to speak, so we'll call for the question.
Michael DeToy.
Aye.
Deborah Gallegos.
Aye.
Troy Johnson.
Aye.
Lisa Middleton.
Aye.
Kevin Pauke.
Aye.
Melissa Willett.
Yes.
Okay, the ayes have it. The motion's approved. I thank you all.
Thank you.
Okay, that will move us to information agenda item 6A, the third-party evaluation and certification of the 2024 CalPERS annual evaluations for public agencies. Give you a little time to get up there and get seated.
Good morning, Mr. Chair, committee members, Randy Zubek, CalPERS actuarial team. My primary role today is to introduce our guest speaker today, Graham Schmidt from Chiron. Graham is going to talk about his firm's third-party parallel actuarial valuations for our June 30, 2024 public agency valuations produced by the Internal Actuarial Office. And a parallel valuation is simply the third party taking our member data, our actuarial assumptions, our plan provisions, and attempting to actually duplicate numbers within our actuarial reports. So this is a different function from what you just heard from Plant Moran. Plant Moran will also be looking at our actuarial work product more in terms of the data that's used, processes and procedures used by CalPERS and the actuarial team. They will not, I don't believe, be attempting to match actual numbers in our reports. That's what Graham's firm was hired to do. So with that, I'm going to turn it over to Graham.
Thanks very much, Randy. Nice to see you all. It's been over a decade since I was last at CalPERS. I had no gray hair back then, so things have certainly changed. First, I also wanted to thank Randy and the rest of the actuarial office. They were extremely responsive in all our requests and really did a great job answering all of our questions. Just want to start off too by saying, as actuaries, I don't mean to sound flip, but we strive for boredom because as part of this process, you probably wouldn't want to have an exciting parallel valuation report, right? And just the good news is that I believe our report is sufficiently boring. We did completely independent calculations of the results for 20 of your systems and found that we were within the desired tolerance levels on all of those measures. So just background, how we approach this, we selected 20 plans, the 10 largest public agency plans, and then a selection of 10 random plans. Random, although we did make sure we selected a group of plans that covered different categories, such as general and safety, cities, counties, and other types of districts, and different benefit formulas. Once we had selected the 20 plans, we contacted the actuarial office. They provided us with the valuation reports and the data, the membership data that was used in all of those valuations. And we also collected the assumptions that were used, which are part of a spreadsheet that's published on the CalPERS website. We generated our own valuation models using ProVal actuarial valuation software, calculated all the key results, and then compared our results to the actuarial office's results that were contained in the valuation reports. We look at 3 primary measurements. We're looking at the total present value of benefits, which are the value in today's dollars of all of the expected benefits expected to be paid to the current members of the plan, both the retired members, members in a deferred status, and the active membership. We then take that present value of benefits and we split it into 2 pieces. Benefits that have already been earned, which is known as the accrued liability, and the amounts yet to be earned for future service, which we call the normal cost. We look at the annual normal cost, which is the cost that is assigned to this year's benefits. And once we have that number, we deduct the membership contributions, the member rates. We are left with the portion of this year's benefits that the employer is covering. And then we add to that the unfunded liability amortization payment, right? So what do you have in terms of your assets compared to your liabilities? And what's the payment that you're making to pay that off over the funding policy adopted by the board? With that, we get to the total contribution rate. So we have those measurements. We have the total value of benefits, the accrued liability that's already been earned, and then the normal cost and the employer contribution rates. Our goal is to be within 3% on all of the liability measurements, the total present value of benefits and the accrued liability, and then within a 5% relative difference to the actuarial valuations on the cost calculations, the total normal cost and the employer contribution rates. The good news is we were within those tolerance levels for all 20 plans. Overall, we were within the accrued liabilities by about 1% or less than 1% in aggregate. And for all systems, we were closer than 3%. On the employer contributions, our goal is to be within 5%. We were within that tolerance level for all systems. And we were within 2 or 3%, I think, on 18 out of 20. So good match. We also reviewed the reports themselves to make sure that they complied with the actual standards of practice. We found that they did. They included all of the relevant disclosures that are required under those standards. We also looked at the assumptions and methods that were used, and we found those to be reasonable and also in compliance with the actual standards of practice. Our reports have a few very minor technical details, none of which would result in any recommendations to change anything that the actuarial office is doing in terms of the calculations. We recommended that they maybe add a sentence or 2 in their reports to enhance some of the disclosures, but the key disclosures are all contained within those reports. So overall, it was a great process. It showed that the results that are being determined as part of your evaluation are accurate and reflect the information that's underlying them. And I'm happy to answer any questions.
Okay, thank you. I'm not seeing any questions. Oh, I am. Mr. Rubalcava.
I'll let the board members, the committee members speak first, if that's okay.
Okay, we'll start with Mr. DeToy.
Thank you for the report. I'm glad it is boring, as you said. Couple questions. So the 3% and the 5% tolerance levels, are those something that is a national standard, or is that something that we decide as a board, or where do those numbers come from?
So it is, those numbers are part of the scope of the project as determined by your board and your system. However, they are consistent with the tolerance levels that we typically see when we are doing actuarial audits for other systems.
Okay. So that is something, as we have aspirational goals, we could try to tighten up in the future, or do you not recommend?
You can try to get closer. However, there are always going to be some differences in the valuation systems that we use in terms of how we do things like rounding, somebody who is a new hire. So you're always going to have some small differences. I'd say that the key number is that total present value of benefits, right? Mm-hmm. What's the total value that you expect to pay out in benefits? And we are well within 1% on that number. 1% is close enough from the actual perspective, especially when you think about how much your assets can vary from year to year.
Absolutely. And then for a plan as complex and large as us, we have the 10 largest plans that you do, and then the other 10 randomly assigned or, plans that you choose, or what is the process for getting to those 10? Do those get excluded in the future? And then is that sample size smaller, or do you think, getting a larger sample size would be better?
So for the 10 largest, it's based on membership. So
yeah, that one's easy.
And essentially those were the same that were done as part of the last actuarial review. For the 10 random plans, we made sure that we did not select any of the 10 that were reviewed as part of the prior parallel review process. I think that 10 is a good sample, especially when we are making sure that we're capturing pretty much every benefit formula that is being paid, as well as these different classes of employees. So I think that 10 is a reasonable sample, especially because every time you do this process, we're getting a new sample of 10 plans. Perfect. We are also looking at individual member test lives as part of this process. So we collect not just for the plans as a whole, but we get the full detailed valuation results for each and every individual participant within that system. So we actually can compare individual liabilities. And as part of doing so, we select a few samples. We can see exactly how those are calculated down to the dollar. And as part of that process, we verified that we thought the calculations were performed correctly.
Perfect. Thank you very much.
Let me just add a couple quick comments to that. So the one or two plans that were anywhere near the 3% threshold on liabilities, we made sure we understood exactly where those differences were coming from. Same with the 5% on the contribution side. And as Graham said, they generally came down to legitimate differences between the valuation systems. It wasn't a mystery why we didn't match. We all knew why we didn't match. And as Graham said, our procedures would be deemed appropriate by their firm and other firms. Also, just to remind the committee that this is phase one of a three-phase contract with Chiron. This was for public agencies. Chiron will be coming back next year to talk about the state and schools reports. And then the third phase will be judges and legislators.
Okay, Director Johnson.
Thank you for the report. Just a question and a comment. The question may be just procedural. The plans in the agencies, even with the 10, not the 10 random, but the other ones, were they picked at random, or were they just the top 10? Or were they given to you?
They are the largest 10 by membership size.
Okay, great. And then just the enhancements, I just want to say they just really elevate the transparency, the things you've identified, and I just think that the more clear that we can make things, the better. So I appreciate those as well.
Thank you.
Thank you.
And let me just add, we also appreciate this process, and we do our best to use it to continuously improve our work product. The recommendations that Chiron had on the contents of the report, how certain things were presented, we will definitely make some modifications to address those. Not for the 25 valuations, those are within a month of being completed, but for the June 30, 26 valuations, we will have those modifications in.
Okay, Director Willett.
Thank you. Thank you for the presentation and the report. And I think, Randall, you just answered one of my questions. So for the reporting and documentation observations in the summary, specifically the second bullet where you that information wasn't available on which members belong to which group, and you recommended adding clarifying language to those exhibits. Is that the thing that you just said are going to fix for next time?
Yeah, that's definitely one of the areas, If Graham and his folks thought it was confusing, then we're going to assume that it is, even though our people have looked at it and sort of get numb to seeing it year after year. We will do our best to make it more understandable.
Thank you. And to follow up on Mr. DeToy's question, I understand the tolerance level of 35% is standard, and 1% is a small percent, absolutely. But I think that the dollar values are still very significant at 1% or less than 1% in some of the cases. I know in Santa Clara County, there's, $14 billion worth of benefits there, right? So 1% significant, especially in some of these public agencies, the large ones that operate public hospitals and are having massive budget restrictions and cuts going into this. That 1% difference could make a huge impact to a member's life or a member's ability to have a job or not have a job. And so I'm wondering, when there are these discrepancies, how would we address those?
So in terms of what causes those types of discrepancies, again, I'll go back to the actuarial software and how it operates, right? So for example, generally, we tend to see larger discrepancies when we have populations that have large groups of newer hires or larger groups of members that are closer to retirement, right? So let's say we have people that are closer to retirement. The CalPERS system includes some expectation of additional cost or normal cost for members that are already at their maximum retirement age, right? Where we assume 100% of people are going to retire. Our system, on the other hand, assumes that those people are retiring immediately, and we don't include any additional normal cost. We assume that all of the benefits have basically been earned by that member. That's just the differences in those two systems and how those two systems operate. And both are reasonable actuarial methodologies for calculating liabilities. Because of that, you are going to get small discrepancies, and those discrepancies can be larger when you're looking at individuals that are at either the early part of their career or very late in their career. So there's no judgment as to whether one of those numbers is correct and the other is not. They are just underlying differences in how our systems calculate things. So it doesn't mean that CalPERS is projecting anything different in terms of the total benefits that are going to be received by these individuals. It's just about how the actuarial software sort of treats these edge cases, rounding what happens at the beginning or the end of your career. Does that answer your question?
It does, yeah. I appreciate that. If we were to go to hypothetical land and say if it was more than 3 or 5%, what would we do then?
We would figure out why we're seeing a difference. And the great thing about, I will say, having done numerous audits, that CalPERS Actuarial Office is the most helpful in terms of giving us the most amount of data that we need to review the results. They are giving us line by line, year by year, age by age, benefit by benefit, exactly how they are calculating all of their results. So we can see exactly the calculations. When we do audits for other systems, a lot of times we're just getting big summary information, and it's harder to get that underlying data. For the CalPERS Actuarial Office, they give us everything. So if there's ever a time where we get to one of these parallel evaluations and there's a calculation where we're not matching, we should be able to establish why that is.
Thank you. My experience with the actuarial office is they're very helpful as well, and always explain things to me in ways that I can understand, maybe not remember, but understand at the moment. So I'm really pleased. Thank you for this report. Thank you to the actuarial office for the work that you do and ensuring that this report comes to us as good as it does.
Oh, there we go. Thank you. Back to Director Rubalcava.
Thank you, Mr. Chair. Thank you for the report. And welcome to CalPERS since you replaced Buck. You mentioned in your opening remarks and then later in some of the response that you use ProVal, which is for your evaluation software, and CalPERS as their internal system. And one of the reading the letter and then looking at the charts, one of the differences, although it is a minor calculation differences, is that CalPERS tends to I don't want to say overstate is the wrong strong word, but has a higher actuarial liability. One thing about actuarial evaluations, you use it to calculate contribution rates and also actuarial liabilities, which tends to mix the press. I think it's, anyway, that's, I won't go into philosophy there, but the point is, as long as we're making the actuary determined contribution, we're good. But I thought it was interesting that it would be that the actual liability is higher under the CalPERS system, which, you know, in a way it's satisfying because that way means we were probably getting more money in than we really need, but I'm not going to go into that either. But it's very minor, right? Except there was one out of the 20, Los Angeles Unified School District Safety. That's the only exception where it's actually reversed, where there is, where your system comes out with a higher actual liability than the CalPERS. So I was wondering if either one could comment on that.
So
both issues, why would that happen, and why would there be one exception?
Again, those differences can come down to sort of the edge cases. So like as I said earlier, one reason why our liabilities might be slightly higher would be if you had a lot of people, especially people at the end of their career where they're assumed to retire right away. And in that case, our system assigns the entire liability to the accrued liability. We're basically saying you're walking out the door tomorrow, so the benefit is already at this point fully earned. CalPERS has a slightly different approach. They assume about a half year of additional service is going to come through. So that's one reason. So if you've got a group like the one you identified that has more people at those edge cases, that's why we can have for that group in particular, we'd see a slightly different result.
Okay. Following up on what you call the edge cases, your letter does point out that how vested termination and refund rates are, can read my notes here, are treated is a big difference. And so I was going to ask about that, but you mentioned it already. And the other thing, there's something about in the actuarial assumptions spreadsheet that there's a footnote that you recommend either be updated or removed. Could you discuss what that is?
Sure. So we have different types of assumptions, right? You have what we call decrements, where somebody is leaving service for different causes. You have rates of members retiring, and then you have rates of members leaving with a deferred vested benefit, right? Or receiving a refund of their contributions. As people go through and get closer and closer to retirement, become retirement eligible, there's a much lower likelihood that they will leave their contribution, they will take their contributions out, right? They're going to be financially harmed if they do so by not claiming their benefits. In the spreadsheet that accompanied the assumptions, there was a footnote that said that the rates of termination don't overlap with the retirement rates, which means that once somebody is eligible to retire, it implied that there wasn't a likelihood that somebody would take their contributions and leave or have a deferred vested benefit. It turns out that that CalPERS actually does continue to apply those assumptions, but it has very little impact because those assumptions are so small. The likelihood of somebody taking their contributions once they are eligible for retirement is, almost nothing. So once the difference in actually applying that rate has really very little impact on the results, and CalPERS, the actual office, confirmed that those rates are being applied and that they would make the appropriate adjustments in any disclosures. Although at this point, those old spreadsheets are moot because you've already adopted new assumptions which are going to be used in the next set of actuarial valuations. Randy, is that?
Yeah, we completely agreed with that comment, and the language has already been changed. Unlike the description of the plan benefits, which we haven't made modifications for, but we will in the 26 valuations. But that was a correct observation, and we've already made the change.
Okay, thank you. And then just to follow up, my final question, the tolerance levels, everybody's within the tolerance levels. It's different. The accrued liability one is plus or minus 3%, but contributions rates is plus or minus 5%. Why are they different? Why is there not the same range of tolerance?
That's a great question. I appreciate all the questions so far. I have to say, these are some of the most great. You guys have actually read this report, so that's very exciting to me. One of the reasons why you have a wider tolerance on employer rates compared to liabilities is due to what we call leveraging, right? Because if you are off on your liabilities by 1 or 2%, it is almost impossible to be closer than that on your contribution rates because you have one number which is fixed, which is your assets, right? And one number which is varying, which is the liabilities when in terms of our measurements, right? We're using the same asset values. So imagine that you had a plan with a $100 billion liability and we came up with a $1 difference in estimate of the liability, but your assets were also $100 billion. The unfunded liability, our difference would be an infinite percent, right? One system is coming up with 1 and one system is coming up with 0. So the percentile difference is immeasurable, even though the actual difference is quite small. So that carries through when you're talking about contribution rates, right? You could have a very well-funded plan and you could show a very small difference in liabilities, but our percentile difference in the unfunded liability payment could be quite large. So that's why you're generally going to see larger differences in the contribution rates because they are leveraged by things like the assets and the member contributions that don't change. Does that answer your question?
Thank you. Thank you. I guess my last question is, the document, the board letter, this is for Randy, states that the actuary office will review and I'm assuming they will report back to us, to this committee on the findings. I know you reported verbally here, you've looked at it and there'll be some changes, some things you can explain away or explain.
Yeah, there's not really a subsequent formal reporting back to the board. The final phase of this contract will be a final assessment of Chiron's investigation of all of our reports. We are stating today that we agree with everything stated in Chiron's reports. We don't expect to make technical calculation changes, although we will take one last look at those. Even if we do make a change here or there, it's going to make a very small difference in our results. We will make modifications in our reports. I guess we will go over those in the final. That'll probably be 2 or 3 years from now. We'll go through all the changes that were made as a result of the recommendations.
Okay, and let me correct myself. I miss sometimes transplanting notes. It doesn't say you review it. It says it will be evaluated. So I guess you've done that.
Yes.
The other thing, I think this is a very good thing where there's a check and balances, because I know many years ago in LA County, they had one actuarial firm and then they changed and there was big discrepancy and big problems there. So I'm glad CalPERS has this policy in place. And I think it's very good also that certain thing, I mean, though you're doing the calculations, there are certain things that you accept, which is one is the actuarial assumptions. And I'm not sure if that was part of the scope of work, but I think that is a very important thing that you do allow, accept CalPERS assumptions because that's who the plan sponsor is. All right, thank you.
Thank you.
That was just a comment, I guess. But thank you, Mr. Miller.
Okay, and I do have one more, Director Middleton.
All right, thank you. Just a couple of comments. First, I want to thank you for the clarity of this report. It was one that your findings were very clear and understandable and greatly appreciated. Earlier, when the previous auditors were up, I asked the question as to whether or not there were any restrictions that have been placed on them. And of course, that's simply the minimum standard that any auditor would have to encounter and would expect that there would be absolutely no restrictions. What you said earlier today is something that I think is worth note, that our auditing staff had anticipated what it is that you were going to be needing and providing that in the kind of detail that you would require and want. And so I want to compliment our staff, our team, and say that's what we expect of you, and it is appreciated.
We certainly appreciate it too.
Okay, I'm seeing no more questions. Thank you very much for the presentations and discussion. It's been extremely valuable, and thanks to both our team and Chiron's team. This turned out to be a very good partnership. I think it's really working well for us thus far, and we look forward to continued good news.
Thank you very much.
Thank you.
Thank you. Okay, I have public comment on 6A before we go to action. Ms. Brown, Margaret Brown.
Thank you. This question is probably for Randy. I'm looking at Appendix A, the comparison of active member data, Table A1 and A2. So if you look at Table A2, the 10 selected public agency plans, the CalPERS active count and the Chiron counts are the same. As you go all the way across those columns, it's pretty much the same until you get to average pay. Average pay for the city of Carlsbad, they're Johnny on the spot, right on the number. But if you look at Table A1, the very last column, Chiron's active average pay is over every single time, which would potentially make our liability higher. So I'm wondering why we are off on the difference between the CalPERS active average pay and the Chiron active average pay. In every instance in that category, they're over. And I'm just wondering what that discrepancy was. I know I don't get to ask the staff that, but maybe you could for us. Thank you.
Thank you for your comments, and I don't know, we don't want to be responding to comments from public commenters in real time here, but hopefully we can get that answer back to Ms. Brown at some point. Okay, so this is an action item, so it's the pleasure of the committee. Oh, is it? Oh, well, information item. Okay, so on to the annual compliance report.
All right, good morning again. Cammie Ebank, Deputy Chief Compliance Officer. Every year, CalPERS compiles an annual compliance report to highlight enterprise-wide compliance, ethics, and risk management activities and accomplishments. The purpose of the report is to demonstrate our effective risk management and oversight by both CalPERS team members and the Enterprise Compliance Risk and Governance Office, so that we can provide the board with a collective view of risk management activities and allow for effective board oversight. CalPERS uses an industry standard framework known as the 3 lines of defense to demonstrate organizational risk management, accountability, and governance practices that emphasize collaboration and accountability through clearly defined roles and responsibilities. I'd like to highlight some of the key accomplishments across CalPERS from this fiscal year, starting with the conflicts of interest oversight. So the Enterprise Compliance Risk and Governance Team, which I'll just refer to as the team because it's a little bit of a mouthful, matured the Investment Compliance Advisory Services Program with our approach to onboarding, advice and guidance sessions for new hires, and also promotions within CalPERS who are covered person individuals and those individuals in the investment office. We also enhanced our compliance awareness resources and our reporting to management. These efforts reinforce our understanding of compliance obligations and promote transparency in ethics and compliance activities. Within monitoring and insurance enhancements we made across CalPERS, these included 100% completion of CalPERS leaders who are required to submit a monthly gift disclosure. The team continues to support the CalPERS team members with ongoing guidance and oversight and identify and address any potential questions that they may have. The actuarial office strengthened data integrity by collaborating with various program areas during the annual evaluation process to identify and correct discrepancies and errors and support more accurate material risk identification and assessment. Within advice and education, the Human Resources Division partnered with our team to assist with implementing automated tracking for compliance, for mandatory compliance and ethics training. The Health Policy and Benefits Program confirmed that all MedInsight users met security and HIPAA requirements that supported ongoing compliance through regular staff training and open office hours. Within the risk assessment and mitigation area, as part of a multi-year initiative, the Information Technology Services branch strengthened our risk management foundation by completing 32 risk and control self-assessments and piloting a new process to reinforce ongoing ownership and accountability for control maintenance. The Information Security Office, in partnership with IT branch, also established a generative AI risk framework to proactively identify and manage risks and support a secure and responsible adoption across the organization. Our customer service branch improved various facets of their disability, retirement, and survivor benefits processes, including improving self-service options on disability retirement pages and implementing workflow solutions to improve efficiencies. These efforts bolster internal controls to help mitigate risk in benefit processing. Under data privacy and protection, the Information Security Office strengthened CalPERS' data privacy commitment by updating key privacy policies and notices, providing clear guidance on personal information protection, and implementing proactive measures to prevent unauthorized access and misuse. HR launched the Secure Data Locker platform for confidential HR data sharing, reducing unauthorized access risk, and improving data governance and compliance. The Health Policy and Benefits Program implemented the Secure Transfer File Protocol for safeguarding member PHI and PII data and developed authorization forms and dashboards for the attestations for the Health Data Nexus to prevent unauthorized access to sensitive information. Within fraud risk management, the Information Security Office, in partnership with Enterprise Solutions Development Division and the Retirement Benefit Services Division, strengthened fraud prevention capabilities by implementing enhanced detection and response mechanisms and improving tools to proactively identify and mitigate external threats. The Information Security Office also partnered with the Identity Theft Resource Center to deliver educational presentations and launched the Preventing Identity Theft at CalPERS webpage to provide guidance on securing personal data and recognizing scams. CalPERS Customer Service Branch advanced fraud prevention by increasing member registrations for My CalPERS accounts, promoting account security, and improving communication through targeted outreach and presentations at key events. And within health policy and benefits and the long-term care and third-party administrator, they utilized fraud detection tools to analyze claims data, referring suspected cases to the Special Investigations Unit to enhance services rendered and the detection of potential fraud. Under policy governance and reporting, the Investment Office adjusted various investment policies to align with investment committee directives, resulting in clear and more user-friendly presentations, and the Investment Office also reviewed internal governance structures to support appropriate monitoring and reporting mechanisms. Moving to compliance and regulatory change management, the Human Resources Division ensured timely compliance with Assembly Bill 692, which was effective January 1st of this year, and all relevant policies were updated and communicated timely across the organization. The Actuarial Office advanced regulatory and accessibility initiatives by progressing report accessibility compliance and proposing amendments to strengthen the fairness and sustainability of CalPERS risk pool operations. And then finally, within the third-party risk management area, the Health Policy and Benefits Program selected a third-party vendor to administer the annual CalPERS Health Plan Member Survey and implemented updated reporting requirements to ensure health plans meet contractual health equity obligations. So as you can see, the organization continues to improve and strengthen our compliance and risk management practices, and it's always encouraging to see the collaboration among CalPERS branches. And with this, I'm happy to answer any questions.
Okay, wow.
That was a lot,
That was
I know.
quite...
But it was important, I think, because there's so many groups that were doing so many things. So to really get that cross-section of CalPERS and understand that it's really everyone working together.
Yeah, that it represents a phenomenal amount of work by a lot of people, a lot of teams, a lot of coordination, and really reflects well on what our priorities are. I don't have any other requests from the committee for questions, so I thank you for the report. And again, thanks goes out to the team and all our partners for getting all this work accomplished.
Thank you.
Thank you. Okay, I think this brings us to summary of committee direction.
I don't believe that there's any summary.
Okay, I would say that getting back to Ms. Brown with an answer to that question, and please share that with the committee. Okay. And that brings us now to public comment. I have several public commenters for 6D, and I'll start with Margaret Brown, and then I believe it's phone callers after that.
I'll just start. Thank you. Margaret Brown, RPEA. I did not get my comment card in for item 4C, so I want to go back to something Ms. Middleton knows I'm very interested in, which is the audited findings, the employer compliance reviews, age findings over 1 year old. When I sat where you are now today, we used to get little bar graphs, and what we instituted was any finding over 1 year old that we would get this, you would get this list. And so I've printed it out. There are actually 86 aged findings over 1 year old, which have not been resolved. And I'm here to talk about 68 of them, which are employment after retirement. So this is retired annuitants problems. 80% of the findings have to do with retired annuitants working for their employers. And I've got to tell you, you had something come up at the last board meeting and it got settled, the item got pulled. But I have to tell you that retirees that get caught up, I don't want to say caught, I don't think they're doing anything wrong, but get caught up in the processes and the procedures, or if the employers have not correctly done something, it is devastating for the retirees or beneficiaries that get trapped in these audits, and it's just devastating to them, and it takes a long time to solve. So I know that staff is working hard on these issues, but we really need to get more support and help with processes and procedures so we don't end up with 80% of the findings being over a year old, that they're all regarding retired annuitants working. And then something else that impacts schools, for those of you that don't know, I retired from school district management. And on May 18th, the CalPERS staff issued a new circular. And it's a new way to determine vacation time used to stay in paid status during fixed school breaks is no longer creditable towards retirement. That's a mouthful. But it's a new interpretation from CalPERS, and it's a significant change impacting how school employers may report compensation earned during vacation time. If you haven't read the circular, take a look at it. It's a nightmare for the staff to implement and for the employee who thinks they've earned that time and now it's all going to be taken away because of a new interpretation. So I'm telling you, you're going to get more findings like this because of that new circular. Ask staff about it. It's very important, and it's going to harm employees. Thank you.
Thank you for your comments. Okay, I think that wraps things up there. So we'll recess now into closed session for items 1 through 3 from the closed session.
We do have one caller on the phone.
Oh, we do. Okay, sorry. We have one caller. Let's hear from our caller on 6D.
Yes, Chair Miller, we have John Holden here to speak to item 6D. John Holden, you are now live and can proceed with your comments.
Yes, hello. My name is John Holden. I'm a San Francisco native. I sat on a pension board of ecology, and I also am now a participant in the GTARP, which is the Golden Gate Transit Amalgamated Transit Plan. We do have Graham Schmidt from Chiron that audits at that plan. I do have some discrepancies with his audit process. He uses the Winklevoss twins software. Where, if you don't know who they are the Facebook crypto twins. So some of the discrepancies you can see, they're trying to move that plan into CalPERS because it is really a huge mess. They took a pension holiday. They have a SPP guaranteed 8% for somebody. That 80% of the liabilities out the door. It's a huge mess of a plan, and they're trying to get it in there. But I understood that the CalPERS audit was much higher contribution than their audit at Chiron. So this is a red flag to me that you really have to. It seems like the CalPERS is internally more robust in their audit process versus some of this other stuff. And so I would really look at these special districts that are running for cover. This one was not funded by an ARC, this plan. It was funded by payroll contributions, and nobody was really coming to work. So the contributions were missing from union officers, from all kinds of officers. So I believe the liability is way higher if you dig down and really start to look at the pension spiking and the stuff. We had the Western Pension Plan attorneys look at it, and all three attorneys came back with that this plan is very problematic. It can be sued because of the California rule. So I would caution you to take on this plan as a fiduciary responsibility. If you do try to take on this plan, I think you will be in breach of your fiduciary responsibility to the overall CalPERS plan. Thank you.
Thank you for your comments. I believe that's all then okay. So at this point, we'll recess now into closed session for items 1 through 3 from the closed session agenda. We'll immediately reconvene in open session after the closed session. So thank you. We'll clear the room. Okay, we're good to go. Okay, we've finished our closed session. We're back in open session. And with no objections, I will adjourn this meeting. We will come back, let's say in 15 minutes at 10:35, and I believe we've got Finance and Administration Committee. So, is that okay with everyone? We'll do that? Okay.
15 minutes.
15 minutes.
Good morning. I'd like to call to order the Finance and Administration Committee, and the first order of business is roll call.
Lisa Middleton,
Present.
David Miller,
Here.
Michael DeToy,
Here.
Kevin Pauke,
Good morning.
Ramon Rubalcaba,
Present.
Yvonne Walker, Melissa Willett.
We are not all present here, so there is an attestation that's necessary. Board members, because we are not all present in the same room and board members are participating from remote locations that are not accessible to the public, Bagley Keene requires the remote board members to make certain disclosures about any other persons present with them during open session. Accordingly, the board members participating remotely must each attest that 1, they are alone, or 2, if there are 1 or more persons present with them who are at least 18 years old of age, the nature of the board members' relationships to each person. At this time, I would like to ask each remote board member to verbally attest accordingly. Dr. Wallace?
Yes. I do attest to the fact that I am alone. Thank you.
All right, thank you. Then we will move on to our next order of business, which is the executive report. Ms. Nix.
Great. Good morning, Madam Chair and committee members. Michelle Nix, CalPERS team member. Today, we added this meeting to keep the asset liability management cycle on track. As such, you will hear the second reading of the Judges 2, and legislators' actuarial assumptions. This is an action item that will be presented by our actuarial team. The next Finance and Administration Committee is scheduled for September 15th, 2026. Thank you, Madam Chair. This concludes my report, and I will be pleased to take questions if you have any.
Are there any questions for Ms. Nix? Seeing none, we will move on to action consent items. I did not receive any requests to pull any consent items. Do we need to take a vote on that? So, roll call, please.
Would you like to ask for a first and second, Ms. Middleton?
Okay, all in favor, please say aye.
First and second for the motion.
I moved approval.
Second.
All right. All right. Do we need a roll call vote? All right, please proceed.
David Miller,
Aye.
Michael DeToy,
Aye.
Kevin Pauke,
Aye.
Ramon Rubalcaba,
Aye.
Yvonne Walker, Melissa Willett.
All right, thank you. With that, we will move on to information consent items. I did not receive any requests to pull anything, and I observe no requests now to do so, so that will be received and filed. We'll move on to our action agenda item, asset liability management, second reading. And with that, Scott, Randy, and Kurt, please take it over.
Oh, thank you. Thank you, members of the committee. I'm Kurt Schneider, Actuarial Office, and today we're going to talk about the actuarial assumptions for the 3 separate retirement systems: judges, Judges 2, and legislators. These are separate retirement systems from PERS, but fortunately, this is going to be very brief. This is, for one thing, the second reading, and there haven't been any changes since the first reading back in March. The other reason why this is going to be pretty brief is that one of the most key assumption, the discount rate for actual valuations, it is actually very important, and as such, it has its own separate analysis and presentation, which recommendation was given to the investment committee on Monday. So we just have to briefly mention it here. Another reason why this is pretty brief, even though these retirement systems are separate from PERS, some assumptions like price inflation, we study kind of across the whole economy, so we don't need to do a separate study for these retirement systems. We're simply going to ask you to adopt the same assumption for inflation for these systems that you've already done for PERS. Mortality review also, while different retirement systems are different groups of people, they could have different mortality assumptions, and we've studied it and determined that they are broadly the same as PERS, and we're going to be recommending you adopt the same mortality assumption for these systems as you did for PERS back in November. Other assumptions like salaries and withdrawal and retirement rates, they really only affect one of these systems, JRS2, and the reason for that is that JRS and LRS are both closed retirement systems. JRS has been closed for over 30 years, closed to new entrants, I mean, which means there's very few actives left. And the legislator system is completely down to simply retirees at this point. And the only assumptions that really affect the measure of the liabilities are the three I just mentioned, the discount rate, price inflation because of retiree COLAs, and mortality because we need to estimate how long the benefits are going to be paid. And all that for those two systems is done already when we're done with the PERS and the discount rate. We'll talk about cost impacts. We'll talk about the impact of PEPR member rates. Now only because the other two systems have been closed for so long, only JRS2 has active PEPR members or ever will have. And then we'll talk about next steps. So the overview, the other thing that is different between these three systems is that the closed JRS system, the first one, is also funded on a pay-as-you-go basis, which means that contributions are only made to satisfy benefit payments. They're not pre-funded. There's no pool of assets there earning money, and because of that, there's some little differences in how assumptions work. Before I go too much farther, it's always important to point out that actuarial assumptions do not change the long-term cost of the plan. The long-term cost will be determined by what benefits are paid and what investment earnings the fund actually earns. What they do affect is the short-term, the required contribution. So, for example, they do affect the funded status of the plans, at least for JRS2 and LRS. Now, I just said JRS, the first one is not funded. No matter what we assume, it's going to be about 0% funded. There's a small amount of assets to pay, benefit payments over the next few months, but our changing assumptions won't change anything. Required employer contributions, for the same reason, JRS is just going to contribute, the state is going to contribute the benefits that get paid out, nothing else. Member contributions, only JRS2 is affected by assumptions because they're the only ones with active PEPR members. But all these systems will impact the information that gets used for financial reporting. The stated liabilities, their GASB, pension costs, and so forth. And the assumptions are also used to create actuarial factors that get used for things like service purchases and optional forms of payments. But LRS, like I said, everybody's retired, and but it is important that we get our assumptions right because at least for JRS2 and LRS, if we are wrong about assumptions, we're either going to understate or overstate the cost, which means employers are going to contribute more than they need to or less, and it'll affect things, contributions later on. So I'm going to go through this very quickly because you've seen it all before, but I'm happy to backtrack and go back over things if there's questions. So the discount rate, Monday, the recommendation for JRS2 and LRS was that there should be no change in the discount rate. For JRS, you probably don't give a lot of thought to what the discount rate is because for JRS it's not funded, so it doesn't depend on the board's decisions about the asset allocation. But we do have a discount rate. We do need to calculate an actual determined contribution when we do evaluation, and we're required under the state statute to recommend some sort of funding if they desire to pre-fund. But it doesn't have any effect on the funded status, it doesn't have any effect on the state or member contributions, and it doesn't have any effect on the factors that are used for service purchases. And you might ask, well, why not? Well, that is because when a member in JRS purchases service, we don't use the GRS discount rate. We use the GRS 2 discount rate. And the reason for that is that the GRS discount rate is very low because it's not pre-funded. There is no equities or private equity or anything to give a higher discount rate. And since the member, by purchasing service, is pre-funding their benefit, we don't think they should be punished for the fact that the state is not pre-funding their benefit. Inflation review, I don't need to go over again because I went over it in March, and it's just the PERS assumption. Same thing with mortality. The other assumptions are just for JRS2. We looked at the service retirement assumptions, disability rates, withdrawals, cash outs, percent married, all that stuff, salary scales. But the only thing that changed, we recommend changes for, are the service retirement assumption and the termination assumption, basically, or withdrawal assumption. The finale here is just an estimate or a calculation of the change in the cost. So again, we're talking about the short-term cost. And these are based on the 25 valuation. Now, these are estimates because the new assumptions won't be adopted until the 26 valuation. For JRS2, there's an increase in the employer normal cost rate of about 0.78%, so less than 1% of payroll. And we don't see that that would impact the PEPRA member contribution rate. That's because the total normal cost has to increase by a full % before there's a recalculation. So it hasn't yet triggered a recalculation, at least not when we look at the assumption change alone. The accrued liability increased by $63 million, which increases the funded ratio, decreases the funded ratio by 2.5%. Now the plan is still over 100% funded, even with this change. So even though the liability is higher, there's no change in the required cost because there's still a surplus, but there is an extra $63 million in liability. For LRS, changes, there's no normal cost because there's no active members. Just increases the accrued liability by $2 million. That's a decrease in the funded ratio of 2.2%. That one's not 100% funded, so it will increase the required contribution somehow. That $2 million has to come from somewhere. And I think that is the end of my slides. Yes. Oh, no, next step. Sorry, one more thing. So the other thing is that for service purchases and retirements, and we're talking just about JRS2, well, no, JRS1 also can have service purchases. So there are new assumptions that are going to be used for that. And those new assumptions take effect, assuming that this gets adopted by the board later today, they'll be in effect tomorrow. And we've been working with IT and benefits to make sure that we'll be ready to do those calculations and there won't be any disruption in service. And with that, I will take questions.
All right, thank you. Are there any questions? This is a second reading and there were no changes. Seeing no questions, I want to thank Kurt and everyone from the actuarial office for the work that went into this, and we're particularly pleased with the judges that were able to accommodate quite easily their request to expand our investment options. So with that, is there a motion to approve?
So moved.
Vice Chair Milner, and second by Trustee Palkey. Roll call, please.
David Miller.
Aye.
Michael DeToy.
Aye.
Kevin Palkey.
Aye.
Ramon Rubalcaba.
Aye.
Yvonne Walker. Aye. Melissa Willett.
Okay. With that, we will move on to summary of committee direction.
I took no direction during this committee meeting.
That's correct. Are there any public comments? With no public comments, then we will adjourn the meeting. President Taylor, when would you like to begin the full board?
No, we have board governance.
Oh, governance is next, okay. So let's do 10 minutes and, okay, we'll start governance at 11 a.m.
business. That's okay. I could shout and bang the gavel, but it won't do me any good.
Oh, you only have to do it once. You don't have to bang it loud. It works. Who needs to do the pledge this time, by the way?
I don't know. Okay. Well, no, do we need to? Yeah, that's okay. Okay, it's my pleasure to call this meeting of the Board Governance Committee to order, and we'll start with our roll call.
David Miller,
Here.
Teresa Taylor,
Here.
Monica Erickson,
Here.
Fiona Ma, Lisa Middleton,
Present.
Ramon Rubalcaba,
Present.
Yvonne Walker.
Okay. Do we have anyone online for the attestation? Okay. Because we're not all present in the same room and board members participating from remote locations that are not accessible to the public, Bagley Keene requires the remote board members to make certain disclosures about any other persons present with them during open session. Accordingly, the board members participating remotely must attest that they are alone, or if there are one or more persons present with them who are at least 18 years old, the nature of the board member's relationship to each person. This time I'll ask Dr. Willis to verbally attest accordingly.
Yes, I am alone. Thank you.
Thank you, Dr. Willis. Okay, and with that, we will move on into our agenda, starting with the executive report.
You were on. Now you're off.
Sorry. I'm new to this. I'm working out the kinks. Good morning, Mr. Chair, Madam Vice Chair, and committee members, Prashant Thirumalli, the General Counsel. We have a light agenda this morning. In addition to the approval of the agenda and meeting minutes, we have the biennial review of the CEO delegation, and then we have a brief update on the board's biennial self-assessment.
Excellent. Seeing no questions, we'll just go right forward into action consent items. It's a pleasure of the committee. Approval moved, seconded.
I'll second.
Okay, seconded by Ms. Erickson. Okay, I'll call for the question.
Teresa Taylor,
Aye.
Monica Erickson,
Aye.
Fiona Ma, Lisa Middleton,
Aye.
Ramon Rubalcaba,
Aye.
Yvonne Walker.
Okay, motion passes. And we'll now move on to our information agenda items. Back to you, Prashant.
Thank you. So this is an information item to update the committee on the work being carried out to implement the board's self-assessment. The board's governance policy requires that the board assess itself every 2 years. We previously consulted with the board president, as in years past. It is our intent for the self-assessment to be performed by Carrie Dominguez from NACD. Ms. Dominguez has facilitated the board self-assessment since 2018, and her familiarity with the board and CalPERS will ensure a productive self-assessment and provide the ability to easily compare results from prior self-assessments. Staff have confirmed Ms. Dominguez's interest and availability to assist the board, and the work is underway to engage NACD. Planning and development for the self-assessment will take place through July, with some combination of surveys and one-on-one interviews conducted by Ms. Dominguez with each board member following that and through August and September. Ms. Dominguez will then present her findings and observations in November and facilitate a conversation with the board. This concludes my remarks. I'm happy to answer any questions.
I'm not seeing any questions, but I'm really looking forward to the self-assessment process and working with Ms. Dominguez, and I would just really encourage all my fellow board members to make the most of this opportunity, and it's been, I've found it very valuable, and I think it's valuable to the board, so I encourage you to be very responsive to the opportunity to meet with her and participate in the process. Okay, I guess that brings us to, oh, yes, we do have a question.
I actually don't have a question. I just want to thank you, Prashant, for getting this started. I do want to let the board members know that if they do have questions before we get Carrie here about how this works or anything, because there are a bunch of new people, feel free to ask right now for Prashant or myself to answer the questions. But it's pretty straightforward. So if there's any questions, please let us know.
Okay, it looks like we do have, okay. So, yeah, so we've got a public comment. Oh, let's do summary of committee direction first.
I think this time there actually is no direction as opposed to last time.
Yep,
So.
good. Okay, so that brings us to public comment, and I have a request for public comment on agenda item 4A from Michael Flairman. Come on down.
Thanks very much. I'm Michael Flaherman, representing our PEA. I know there are a lot of different directions that the self-assessment survey can go in, and I would urge the board to make sure that one of the things that the self-assessment really probes is how satisfied members of the board are with what I would describe as the vital role of the board. Questions about whether the board is meeting enough, whether the board is voting enough, whether the board, especially over investments, is receiving a real full stream of information sufficient to really exercise its legal responsibility over everything, or whether instead the information it's receiving is highly curated. I noticed, I went back and looked that the board hasn't voted, the investment committee hasn't voted on an investment transaction since 2018, or at least nothing has been noticed, I should say, to be more precise. Nothing's been noticed as an action item as an investment transaction since 2018, and maybe that's something that you should be thinking about. So that's my comment about the self-assessment survey. Thanks very much.
Yeah, thank you for your comments. Okay, I don't believe there are any more requests from the public to speak. So hearing no objections, I will adjourn the meeting. Okay, we're adjourned, and so I will give President Taylor the mic.
All right.
Oh,
you missed.
There you
go. So we're adjourning the meeting. We're having lunch. We're going to go after that at 12:15 to raise the pride flag, and then we will be back for full board about 12:30. Okay? So we will see you all at 12:30. Thank you very much. Okay, we are good to go. Good morning, good afternoon, I am sorry. So used to morning for this. We are in the Board of Administration. I'd like to call it to order with roll call first.
Teresa Taylor.
Here.
David Miller.
Here.
Deborah Gallegos. Here. Michael DeToy. Monica Erickson. Troy Johnson. Fiona Ma.
Excused.
Lisa Middleton.
Present.
Kevin Pauti.
Good afternoon.
Vermont Rugaba.
Present.
Yvonne Walker. Here. Melissa Willett. Here. Dr. Gail Willis.
Present.
All right, with that, I have asked Troy to give us a Pledge of Allegiance, and he has agreed to do so.
Everyone please stand. Ready, begin.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you, Mr. Johnson. I appreciate that. With that, I am going to start my board president's reports. So I want to start today by recognizing Pride Month and Juneteenth. I'm so proud to report that earlier today we raised the Pride flag at CalPERS for the first time. Thank you so much for all those involved in putting this together, for our diversity, head of diversity, Sherry Slate, and for Michelle Tucker and all of the community that works here. And I'm so very proud that we did this. It is a meaningful milestone that highlights our commitment to the inclusion and belonging that respects the diverse backgrounds of the people we work with, the members we serve, and the team who works here. So again, I'm so proud of our decision to raise this flag to celebrate and recognize this inclusion and belonging for our staff and our members who are part of the LGBTQIA+ community. Diversity in all its forms strengthens us. It leads to nimble, innovative teams and supports our ability to serve members across all three business areas. Pride Month is a time to honor the LGBTQ+ community, celebrate the progress that has been made, and reflect on the ongoing work needed to ensure dignity, respect, and inclusion for all. The rainbow flag serves as a powerful symbol of acceptance, authenticity, and the collective progress made by the LGBTQIA community over the years. Here at CalPERS, we are committed to being allies and partners in that progress. Today, our CalPERS Diversity and Inclusion Group is hosting a community pride table next to the cafe over that way to honor Pride Month and share information with anyone who is interested to learn. Happy Pride to everybody. Thank you. With that, I will move on. Juneteenth, observed on June 19th this week, commemorates the day in 1865 when enslaved African Americans in Texas finally learned that they were free, 2 years after they were freed officially. It marked a powerful moment in our nation's history and a reminder of the enduring importance of freedom and justice. I'd like to next congratulate Melissa Willett and Kevin Pauti on being reelected to the board, each for another 4-year term as the public agency and school representatives, respectively. Their continued service and leadership are greatly appreciated, and we look forward to our work together. And I also want to congratulate Cecilia Wilson on her election to the board representing state employees. You will see her all the way in the back of the room. Cecilia will be taking over my seat since I have retired and will be stepping down from the board next January. For those who don't know her, Cecilia works for the California Department of Education as an information technology professional and has more than 36 years of CalPERS covered service. Good on you, Cecilia. I'm confident Cecilia will represent all our members well. All the new terms will begin January 17th, 2027. So right now, really quickly, I'd like to take a moment of personal privilege. So I want to tell everyone I really appreciate everyone's right to speak freely at these board meetings during public comment. I also respect our members' right to lodge their complaints and constructive criticisms. I only ask that when you do so in this public venue, that you please show some basic courtesy, respect, and kindness in these comments. There were comments made by several people on Monday and Tuesday that were not constructive, and I wouldn't even call them just criticisms. They were mean-spirited and just plain rude to our staff and our board. I know that most people are much more receptive to your messages, folks, when they're delivered professionally and with respect. And in that spirit, I hope we can move forward with all of you to continue to hear and respect each other. And I also want to thank everybody today who's made public comment, because everybody was respectful and professional today. So with that, I'm also going to go into, there was a kind of a big hullabaloo over, and I know that's not a word. It's a big word. There was a lot of concern and commentary around the committee chair's decision to reduce the time for public comment. This has been a past practice since I started on this board. It's also been very common. The chairs of the committees are, by regulation, allowed to reduce public comment time when there are a lot of commenters, and to make sure that we can give everyone the opportunity to comment, and we have done it on many occasions. In the same vein, we have been asked to make public comment longer for some folks because they had an extra thing they wanted to say, okay? And we have done that. It is up to the chair according to regulation, and I just want to make that clear. These decisions have been up to the chairs. The regulation is section 552.1. I'm just going to read it really quickly. The presiding officer may increase or reduce the time limit set forth in subdivision B2 in a viewpoint neutral manner. When exercising this discretion, the presiding officer shall consider the time allocated for the meeting, the length and substance of the agenda, whether the body is in danger of losing a quorum, or the schedule of the other body or body's business later than the same day, the number submitted requests to speak, and other similar factors. So I just want to make that very clear. When we have investment committee, and it's been more lately, almost every single meeting, we have lots of people who want to make comments. So it is some truly up to the chair by regulation. So with that, I'm going to go on to, after my thank you for the point of personal privilege, I do want to remind everyone about the board's offsite in July. It will be held at the Monterey Beach Hotel in Monterey, California. It used to be the Tides, in case anybody's wondering. Please mark your calendars if you can join us. So I'm going to finish with Arnie Phillips, our Managing Investment Director over Global Fixed Income, who is retiring after more than 3 decades with CalPERS. So we do have a resolution. Do we have it up? Did we want to put it over there and let people take a look? You don't have to hold it. Oh. I mean, you can walk around with it. No, I'm kidding. So this tribute to Arnie and what the resolution says, so I'm going to go ahead and read it. Whereas Arnie Phillips has dedicated more than 30 years of his career to CalPERS and leaves a legacy of hard work, team collaboration, and for being well-liked and respected, particularly for his great sense of humor, which lightened the load of the investment office's important work. Whereas Mr. Phillips served in multiple roles in global finance income, starting with the short-term portfolio, followed by trading investment-grade corporates, and then mortgage-backed securities, and ultimately as the managing investment director. Whereas he always did what was needed and asked of him, Arnie put the organization's needs above his own and stepped up to serve in several leadership roles. And whereas his leadership encompassed roles as Managing Investment Director over Global Fixed Income, Interim Deputy Chief Investment Officer over Public Markets, Mr. Phillips embraced both with a sense of duty to CalPERS members, team members alike, and always projecting a positive attitude, especially during the remote work experience of the COVID pandemic. Whereas Arnie strove to bring silos down in the investment office, he will be missed for his leadership style that valued substance over form, along with his advocacy of cross-sector collaboration. Whereas Mr. Phillips served as an important example of balance in the workplace for his colleagues to emulate, Arnie was also a dedicated, high-performing contributor to the CalPERS investment office. Whereas Arnie recognized culture and morale were important factors to success and wasn't above dressing down or embarrassing himself for the sake of providing some levity, including his spirited participation in the annual holidays ugly sweater competition, which further endeared him to his colleagues. Whereas his renowned love of a good burger paired so well with a leadership style that has exemplified integrity, compassion, excellence in his nearly 33 years of public service to the members of CalPERS. Now, therefore, be it resolved, the CalPERS Board of Administration, individually and as a body, express our sincere appreciation to Arnie Phillips for his many contributions and outstanding service to the system, and extends our sincere best wishes to him in future endeavors. I'm sorry Arnie couldn't be here, but thank you. I think he's away enjoying his retirement already, isn't he? With that, I'm going to turn it over to Marcy Frost for her CEO report.
Teresa, if we could do the attestation.
Oh,
before,
the
please.
attestation, sure. We're not voting yet, though. Good morning, or good afternoon, board members. We're not all present in the room, in the same room, and board members are participating from remote locations that are not accessible to the public. Bagley-Keene requires that the remote board members make certain disclosures about other persons present with them during open session. Accordingly, Gail Willis, would you attest that you are either alone or there are one or more persons present who are at least 18 years old, and the nature of the board members' relationship?
Yes, I am alone. Thank you.
Thank you very much. With that, we will move on to Marcy's CEO report.
These are our Apex winners. Apex is the highest honor a team member can receive here at CalPERS. This year, we have 38 honorees who represent 17 different divisions. They received their awards at a ceremony here in this auditorium earlier this month. One of the things that I especially like about the Apex Award is that these recipients are nominated by their coworkers, their teammates. It takes a whole team of colleagues to put together a nomination packet, which must include 12 outstanding examples of the nominees' work over the last year. A special selection committee also appears, reviews each packet, and decides whether the nominees' work truly reaches the level for the Apex Award. I'm very proud of this year's recipients. Many of them are here in the auditorium with us, and will you all please take a moment to stand and be recognized. We also had breakfast with them, and HR did just a really nice job of doing more of this kind of speed dating roundtable where we positioned ourselves at a table and got to meet all of the nominees or all the recipients with sharing breakfast one morning. It was really quite fun. So this week, we also heard from members of our health division about the way that they are actively working to provide high quality, accessible, and affordable health care to over 1.5 million members and their families. Our team approaches this process methodically, and they are prepared with the data and the information that they need to negotiate rates. They compare each health plan's premium proposal against actual claims that show how members are actually using the services and how much they cost. They also look at larger cost trends in the healthcare market. We require actuarial certification and third-party verification of all rate projections submitted by the health plans. We do this to prevent unwarranted premium increases from being passed along to our members. And we believe that approach is working. For the third year, our projected increases are lower than the year before. Our preliminary estimate for 2027 is that rates for all plans will increase by 4.98% on average. Medicare premiums on average will remain essentially flat. Our expert team under Don Molds is not afraid to say no also when a health plan proposes a premium increase that we consider unacceptably high and unsupported by our data, as we are doing this year with United Healthcare. I appreciate all the work they've done to prepare for communicating this change to our members and finding new ways and plans to make sure that most people would not see a significant disruption in their care. The active data-informed approach of our healthcare team delivers true value for our members. Our investment team also adds value through their active stewardship of the portfolio. Both of these teams are constantly innovating and demonstrating excellence in their fields, a term that Kevin Palke used quite frequently over the last few days. This week, we heard annual reports from the private markets teams showing their performance and their relative strategies. We heard how our sustainable investments team works across all of the asset classes and their diligence to manage a resilient, future-proof portfolio, whether it's building renewable energy infrastructure or making private equity investments in younger firms. And those younger firms are really the ones developing the technology that will help us to adapt to a changing climate. Over the past 6 months, we've been actively highlighting the work of all of our teams with posts on our Perspective blog and accompanying video stories. Today, we are posting a video introducing some of our key investment team members and the passion they bring to their work on behalf of our members. I hope you enjoy it.
I'm Stephen Gilmore. I'm the Chief Investment Officer at CalPERS, and I oversee the investment team here. The most important thing that the investment team does, of course, is to invest the portfolio. And we do that with the aim of generating strong risk-adjusted returns so that we can pay future pension benefits. We're looking after the pension benefits of 2.4 million members, and that is really rewarding.
I am Roselle C., Investment Director in Private Debt. I've been with CalPERS for 25 years. It is a blessing to be here, to be honest, dealing with different people, very smart people, and people with, I think, good hearts and good intention is what keeps me going.
Anton Orlich. I've been working at CalPERS as head of private equity since 2022. Private equity is one of our asset classes that is focused on getting higher returns. It's basically ownership of companies. Companies are responsible for employment. It's what allows us to support our families. Some of those companies are public, some of those companies are in the private equity space. Some of the advantages that private equity firms do have on average, such as the fact that they tend to focus on longer term horizons, and they're less susceptible to the noise of the public markets.
My name is Simiso Nzima. I've been at CalPERS for 21 years now. I'm head of Global Public Equity, which manages about $220 billion of public equity investments. We have a team which is really, really diverse in terms of their experiences, backgrounds, where they grew up from, the things that they've done in life, and having those people come together makes for sort of a stronger way of looking at investments. When you look at our outcomes, we can see that, for example, from a public equity perspective, over the last 5 years, we've outperformed the index by 25 basis points on an annual basis. And that may seem like a small amount when you're talking basis points. That's $2.4 billion cumulative over a 5-year period. That goes a long way in, securing the retirement benefits of CalPERS members and their beneficiaries.
My name is Bashar Zakaria, and I've been with CalPERS for close to 24 years, and I'm the head of emerging market research. My main task is to cover the emerging market universe for CalPERS, understanding their economies, analyzing their debt securities, and offer recommendation whether we should get involved or avoid certain economies. Being here for 24 years, I've seen countries going from very weak to strong, going back to weak phase, and it's never a dull moment.
My name is Juan Gaviria. I'm an investment director within real assets infrastructure. I really enjoy being able to invest in hard physical assets that we all see on a day-to-day basis. For example, when we invest in transportation, we improve road connectivity, or our experience in an airport gets better. Or if we invest in power generation and battery energy storage. We make our grid more resilient, greener, and with less emissions.
Hi, I'm Peter Cashin. I'm heading up Sustainable Investment at CalPERS. We target investing in climate solutions. As we know, climate change is happening. So we need to be aware of both the risks and the opportunities associated with climate change. A second area is emerging and diverse managers. So we want to target the managers that will generate the best returns. Our data and research has demonstrated that new managers that are just coming into the industry have shown that they can generate outperformance because they're targeting a specific niche that's often missed by others. So that is a real key focus area for us.
My name is Tamara Sells. I've been working at CalPERS for close to 12 years now. Personally, I am a future pensioner and also a professional here in the office. So I feel that I have a personal and professional interest in the success of the fund. Over the time of your lifespan, you will reach significant milestones, and one of them being retirement. Being a part of securing something that is so important, so hard worked for and so hard earned, gets me up every day.
Our members understand and get to know a little bit better the team that's securing their benefits, and this video is intended to be really just a first iteration of many more to come. So, President Taylor, that does conclude my report. I'm happy to take questions if there are any.
Do we have any questions from the board? All right, thank you very much, Ms. Frost.
For lights on. No.
I'm actually giving Ms. Willett a point of personal privilege.
Thank you so much. Thank you, Madam President. I am speaking on 2 points of personal privilege today. Firstly, colleagues and members of the public may have noticed that when we take votes, I say yes or no instead of I or nay. And I want to say that I do that intentionally because I think it matters. I do it because I is a vowel-only sound. It has no consonant sounds to anchor it. So for people who are hard of hearing or who rely on hearing aids, lip reading, or live captioning, it's one of the least intelligible words in the English language. Yes, by contrast, has distinct consonants at both ends. It is clear, it is more visible on the lips, it is more accessible across languages and abilities. So for any interpreters and non-native English speakers watching at home, I is an archaic parliamentary term that has no clean equivalent in most languages. Well, yes has direct translation, is easy to translate when needed. So I think that this board does serve over 2 million Californians. Some of them are watching these meetings, some of them have hearing loss, and some of them are listening through an interpreter. So the least we can do is make sure they can hear how we vote on their behalf. And it's a small thing, but I think it matters because accessibility matters. My second item is that I'd like to take a moment to recognize something that came to me directly from a CalPERS member. A member named Kelly reached out to share her experience after submitting a spouse and survivor question to CalPERS. In her words, she received an actual phone call from my local CalPERS office manager, Jonathan, who took the time to call me and answer a question. She went on to say she very much appreciates him taking the time to call me to make sure I understood the answer, and credited him with taking the extra step in providing good client service. So I want to echo Kelly's thoughts. That is exceptional service. I know Jonathan provides exceptional service, and it was great to hear from a member. For a member navigating a spouse and survivor decision, one of the most consequential choices a CalPERS member and their family will ever face, that kind of care matters enormously. And I want to personally thank Jonathan, the manager of our San Jose regional office, for that level of attention to a member's concerns. I also want to be clear that that service doesn't happen because of one person or in a vacuum. It happens because of a team, and I want to extend that same appreciation to every member of the Jonathan's team at the San Jose office who show up every day to support our members and put up with me quite regularly. And I also know that that team culture doesn't happen by accident either. So I want to extend my appreciation to David Rubio, who oversees all of our CalPERS regional offices, for setting the tone that makes this kind of service possible. Finally, hi David. I want to note that Jonathan and his office have been strong partners to SEIU Local 521. They'll be joining us actually at our member resource fair today in San Jose, bringing CalPERS expertise directly to our members. And I think this is what it looks like when CalPERS works the way it should for our members. I wanted to let this board and the executive team know. Thank you.
Thank you, Ms. Willett. With that, we will move on to the agenda. Number 5, action consent items. What's the pleasure of the board? Moved by Mr. Miller? Seconded by Mr. Palkey. Can I have a roll call vote, please?
David Miller.
Aye.
Deborah Gallegos. Yes. Michael DeToy. Monica Erickson. Yes. Troy Johnson.
Yes.
Fiona Ma.
Excused?
Lisa Middleton.
Aye.
Kevin Palkey.
Aye.
Ramon Rubalcaba.
Yes.
Yvonne Walker.
Yes.
Melissa Willett.
Yes.
Dr. Gail Willis.
Aye.
Thank you very much. Motion carries. Information consent items is agenda item number 6. I have not received a request to move any off of the reports, so we're going to move on to agenda item 7, which is committee reports. And with that, we're going to start with investment committee. Mr. Palkey. There. Whoops. Hold on. There we go.
Thank you, Madam President. The Investment Committee met on June 15th, 2026. The committee approved the following: Agenda Item 5A, Total Fund Policy Review, second reading. Agenda Item 5B, Asset Liability Management, second reading, Affiliate Funds, recommendations, and Agenda Item 6B, Asset Liability Management, first reading, Supplemental Income Plans, recommendations. The committee received reports on the following
I have
topics.
to vote on this. I have to vote on this.
Thank you.
Thank you. On motion by the committee, what's the pleasure of the committee? I'm sorry, on motion by committee, all those in favor, and I need a roll call vote. My bad, sorry.
David Miller.
Aye.
So we are on, if you have
In the
your,
investment committee.
okay,
read
and
out,
all of
yeah.
these items, agenda items, are to be voted on.
Okay, so.
So he read all of the agenda items, and we are now
Oh,
voting on
I got
them.
it. Understood. Understood.
Okay. Now can we have the roll call vote?
David Miller.
Yes.
Deborah Gallegos. Michael DeToy. Monica Erickson. Troy Johnson. Fiona Ma.
Excused?
Lisa Middleton.
Aye.
Kevin Palkey.
Yes.
Ramon Rubalcaba.
Yes.
Yvonne Walker.
Yes.
Melissa Willett.
Yes.
Dr. Gail Willis.
Yes.
With that, motion carries. Go ahead, Mr. Palkey.
The committee received reports on the following topics: Quarterly Chief Investment Officer Report and the Private Equity, Private Debt, Real Estate, and Infrastructure Annual Program Reviews. The chair directed staff to provide historical data on active risk positions and policy ranges, report back on whether sitting risk is a component of the assessment framework for AI infrastructure and data center investments, create a work group to consider changes to the investment committee meeting schedule, and to move general public comment to the beginning of future investment committee meetings. The committee heard public comment on the following topics: private equity, specific CalPERS investments, total fund policy review, private debt, real estate, and infrastructure. At this time, I'd like to share some highlights of what to expect at the September Investment Committee meeting: Asset Liability Management First Reading, Affiliates Policy Updates, CalPERS PERF Trust Level Review, and Global Fixed Income and Private Equity Annual Program Reviews. The next meeting of the Investment Committee is scheduled for September 14th, 2026 in Sacramento, California.
Thank you very much, Mr. Palkey. With that, I'm moving on to, hold on, public comment on 7A. For that is JJ Jelensik and Michael Flaherman. Can you come up here? Go ahead, Mr. Jelensik.
JJ Jelensik, RPA. After Monday's private equity sales job, performance review, program review for private equity, I had to do some editing on the fly because too many people wanted to talk about it. But the Jonathan Weld article that I referred to really has some important things that I think you need to hear. So I'd like to bring up some of the things that got edited out. The markups might reflect bargain hunting, buying stakes at a discount to a fund's official net asset value. But they also defy the conventional notation that an asset is only worth what somebody else is willing to pay for it. The problem arises when certain evaluations look too good to be true, undermining the credibility of others. Like their counterparts in private credit, private equity funds are supposed to mark their assets to fair market value each quarter. These assets usually lack market quotes and are difficult to value. This opens the door for managers to rely on subjective pricing models when they invest in other funds. The accounting rules allow them to simply adopt the net asset value, NAVs, provided by other managers. That's how the Stepstone Fund was able to record its same-day markups. On December 31st, 2023, a different fund, Stepstone Private Ventures and Growth Fund, paid $538,100 for a stake in a venture capital fund called CNK Fund 4. That same day, it marked it up 16-fold to $8.7 million. These paper gains lead to sizable fees. Stepstone Private Venture, for instance, reported $424.4 million in net unrealized gains for a 6-month period. During that period, it accrued $60.7 million in incentive fees, despite recording only $1.4 million in net realized gains. It goes on to say, the California Public Employees Retirement System last year said $103 billion, or 15% of its investment portfolio, was in private equity. It valued those holdings using the NAVs from other managers. CalPERS said its PE investments earned 14.3% return in fiscal 2025. When these evaluations are this squishy, it's hard to know what the returns really mean. The article goes on and makes a number of points, but those were the ones I wanted to put forward to the board for their education.
Thank you very much for your comments. Mr. Flerman?
Hi, I'm Michael Flerman here on behalf of our PEA. I want to return to the tax distribution issue I raised at the investment committee. The law firm Debevoise and Plimpton publishes a private equity guide that explains the purpose of tax distributions. It states, quote, tax distributions to the general partner help to ensure that the investment professionals have sufficient funds to pay their taxes. McFarland's, another law firm, has a document on its website titled Tax Distributions and Carry Clawback. It explains that tax distribution provisions are designed to help individual carried interest holders manage tax liabilities arising before they receive carry distributions. I now call your attention to the one-page document with yellow highlights that was just handed out to you. This is the tax distribution language from 2 actual contracts for funds that CalPERS invested in. The first one on one side from Carlyle Partners 5 is the LPA section titled Tax Advances. It says that the Carlyle executives, referred to as beneficial owners of carried interest, may receive, quote, a cash advance against distributions of carried interest, unquote, so they can pay income taxes. The Blackstone 6 excerpt on the other side is very similar. It says the general partner may receive a, quote, cash advance against general partner carried interest distributions when distributions are not sufficient for the general partner, its members, or beneficial owners to pay income tax. These are obviously not obscure managers, but 2 of CalPERS's largest relationships. The language labeling these payments as advances does not eliminate the fiduciary issue. If sufficient future carried interest is not earned, there is no repayment obligation on these tax advances. So the question for this board is not whether the provisions exist. They do. The question is whether the CalPERS board has ever publicly reviewed whether it's fiduciarily sound for the CalPERS trust fund to be used to fund tax advances for private equity executives. I'm not asking the board to deliberate today. Instead, I'm urging that one of you request that this issue be placed on the agenda of a future noticed public meeting. You're allowed to do that. You're allowed to ask for an issue to be agendized for future discussion. Thank you.
Thank you, Mr. Flaherman. With that, we will move on to 7B, which is Pension Health Benefits Committee. Mr. Rubalcava.
Thank you, Madam President. The Pension and Health Benefits Committee met on June 16, 2026. The committee recommends, and I move, the board approve the following. Agenda item 5A, approve the family building benefit for our PPO basic plans as presented by staff effective July 1, 2027.
Thank you. On motion by committee, any discussion on the motion this time? Okay, seeing none, can we have a roll call vote, please?
David Miller.
Yes.
Deborah Gallegos.
Yes.
Michael DeToy. Yes. Monica Erickson. Troy Johnson.
Yes.
Fiona Ma.
Excused?
Lisa Middleton.
Aye.
Kevin Palkey.
Yes.
Ramon Rubalcava.
Yes.
Yvonne Walker.
Yes.
Melissa Willett.
Yes.
Dr. Gail Willis.
Aye.
All right, with that, Mr. Rubalcava, can you move on?
Yes, thank you everybody for the vote. The committee received reports on the following topics. The committee received the preliminary 2027 health maintenance, or the HMO and PPO plan premiums. The committee received public comment regarding concern with Amador County being grouped into Region 1 and the health plans available in that county, and also the other testimony on the risk of investing in private equity acquisitions for healthcare. The chair directed staff to schedule a future health plans spotlight with Sutter Health Plan and prepare communications for inclusion in stakeholder newsletters regarding the exit of United Healthcare's basic plans for the CalPERS health program and resources available to members to support them through the transition. At this time, I would like to share some highlights of what to expect next month and at the September Pension and Health Benefits Committee meeting. Final HMO and PPO health plan rates will be approved at the July Board of Administration offsite. The committee will be presented with contracting agency health regions, refined modeling and scenarios, and will review to approve a clinic contract and limited duration regulations. The next meeting of the Pension and Health Benefits Committee is scheduled for September 15, 2026 in Sacramento, California. Thank you.
Thank you, Mr. Rubalcava. With that, we will move on to 7C, which is Finance Administration Committee. Ms. Middleton.
Thank you. The committee recommends, the Finance and Administration Committee met on June 17, 2026. The committee recommends, and I move, the board approve the following. Agenda item 5A, adopt new actuarial assumptions for JRS, JRS2, and LRS to be effective June 30, 2026, with actuarial valuations, and use the recommended assumptions in all affected member calculations effective as follows. A, for service credit purchase applications postmarked on or after June 18, 2026. B, for retirement plan options for retirement dates on or after June 18, 2026.
On motion by committee, is there any discussion on the motion? Seeing none, with that, could we have a roll call vote?
David Miller.
Yes.
Deborah Gallegos.
Yes.
Michael DeToy. Yes. Monica Erickson.
Yes.
Troy Johnson.
Yes.
Fiona Ma. Lisa Middleton.
Aye.
Kevin Palkey.
Aye.
Ramon Rubalcava.
Yes.
Yvonne Walker.
Yes.
Melissa Willett.
Yes.
Dr. Gail Willis.
Aye.
Nay? Was that a nay?
No, aye.
Aye. Okay, sorry. Please go on, Ms. Middleton.
All right, thank you. At this time, I would like to share some highlights of what to expect at the September Finance and Administration Committee meeting. Annual actuarial valuations, terminated agency pool, modernizing investment data and technology update. The next meeting of the Finance and Administration Committee is scheduled for September 15, 2026 in Sacramento, California. Thank you.
Thank you. With that, I am moving on to item 7D. For that, that's Mr. Palkey. Please go ahead.
Thank you, Madam President. The Performance Compensation and Talent Management Committee met on June 16th, 2026. The committee recommends, and I move, the board approve the following. Agenda Item 5A, Annual Review 26-27 Incentive Metrics. Approve the incentive metrics for fiscal year 26-27 as presented by the board's compensation consultant, Global Governance Advisors. And Agenda Item 5B, 26-27 Incentive Plan of the Chief Executive Officer. Approve the fiscal year 26-27 Incentive Plan for the Chief Executive Officer, CEO, as proposed by the board's compensation consultant, Global Governance Advisors.
Thank you. On motion from the committee, any discussion on that motion? Seeing none, please do a roll call vote.
David Miller,
Yes.
Deborah Gallegos, Michael DeToy, Monica Erickson, Troy Johnson, Fiona Ma,
Excused.
Lisa Middleton,
Aye.
Kevin Palkey,
Aye.
Ramon Rubalcaba,
Yes.
Yvonne Walker, Melissa Willett, Dr. Gail Willis.
Aye.
All right. Please go ahead, Mr. Palkey.
The chair directed staff to provide additional information regarding introducing annual risk considerations for next year, establishing a mid-year checkpoint to review risk and overall performance, providing updates on the feasibility of legislative changes that would allow CIO and CEO input on incentive metrics, and conducting discussion on qualitative performance ranges. The committee heard public comment on the following topics: incentive metrics and reward structures, level of performance for incentive payouts. At this time, I'd like to share some highlights of what to expect at the September Performance Compensation and Talent Management Committee meeting. The committee will conduct an annual performance evaluation of the Chief Executive Officer and review the CEO's report of fiscal year 25-26 performance for executive and investment management positions in closed session. The next meeting of the Performance Compensation and Talent Management Committee is scheduled for September 15th, 2026 in Sacramento, California.
Thank you, Mr. Palkey. With that, we will move on to the Risk and Audit Committee. And for that, that's Mr. Miller. Please go ahead.
Yeah, the Risk and Audit Committee met on June 17th, 2026. The committee recommends, and I move, the board approve the following. Agenda Item 5A, the Enterprise Compliance Risk and Governance Annual Plan. Agenda Item 5B, Office of Audit Services Annual Plan. And Agenda Item 5C, Independent Auditors Annual Plan.
On motion by the committee, is there any discussion on the motion? With that, can we move into a roll call vote?
David Miller,
Yes.
Deborah Gallegos, Michael DeToy, Monica Erickson, Troy Johnson, Fiona Ma,
Excused?
Lisa Middleton,
Aye.
Kevin Palkey, Ramon Rubalcaba,
Yes.
Yvonne Walker, Melissa Willett, Dr. Gail Willis.
Yes.
With that, motion carries. Please move on, Mr. Miller.
The committee received reports on the following topics: an update on the third-party valuation and certification of the 2024 CalPERS annual valuations for public agencies, and an update on the 2025 through 26 annual compliance report. The committee heard public comment on the following topics: enterprise compliance activity, 2026 through 27 enterprise compliance, risk and governance annual plan, public agency plan, quarterly status report findings, and audit processes. this time, I'd like to share a highlight of what to expect at the September Risk and Audit Committee meeting, the Conflict of Interest Program Update. The next meeting of the Risk and Audit Committee is scheduled for September 2026 in Sacramento, California. That will conclude my report, Madam President.
Thank you. You are now up for Board Governance Committee.
Okay. The Board Governance Committee met on June 17th, 2026. The committee recommends, and I move the board approve the following. Agenda item 3C, approve the current CEO delegation resolution as presented in the agenda item.
I'm sorry. On motion by the committee, any discussion on the motion? And seeing none, can we have a roll call vote?
David Miller,
Yes.
Deborah Gallegos, Michael DeToy, Monica Erickson, Troy Johnson,
Yes.
Fiona Ma,
Is excused.
Lisa Middleton,
Aye.
Kevin Pauke,
Aye.
Ramon Uvarcava,
Yes.
Yvonne Walker, Melissa Willett, Dr. Gail Willis.
Aye.
Thank you. Motion carries. With that, Mr. Miller, can you move on?
The committee also discussed the board's self-assessment and the steps for satisfying this requirement for this cycle. The next meeting of the Board Governance Committee is tentatively scheduled for September 16th, 2026 in Sacramento, California. And that concludes that report, Madam President.
All right. So with that, we're going to move on to the proposed decisions of administrative law judges, and that's you again.
Okay. I move to adopt the proposed decisions at agenda items 8A1 through 8A6 with the minor modifications argued by staff to agenda items 8A1, 2, 5, and 6.
I need a second on that, right? Okay. I need a second. Mr. Palke is giving us a second. With that, I will have a roll call vote.
David Miller,
Yes.
Deborah Gallegos, Michael DeToy, Monica Erickson, Troy Johnson, Fiona Ma, Lisa Middleton,
Aye.
Kevin Pauke,
Aye.
Ramon Uvarcava,
Yes.
Yvonne Walker, Melissa Willett, Dr. Gail Willis.
Aye.
Thank you. Motion carries on that. I have action agenda items B, Senate Bill 1038. Danny, if you want to give us an update on that. And then 1089, just, I think that's got pulled, so if you want to just go over that.
Good afternoon, Madam President and board members. Danny Brown, CalPERS team member. This first item is an action item. SB 1038, authored by Senator Laird and sponsored by the California School Employees Association, adds some new requirements regarding CalPERS employer audits and codifies some existing practices. First, SB 1038 requires CalPERS to list on its website the name of the employer that is subject to an audit and the purpose and scope of the intended audit prior to initiating an audit. Second, it codifies existing practices by requiring CalPERS to provide written notice to the affected employer of the purpose and scope of the audit and provide the employer with a copy of the final audit report. Finally, it requires the audited employer to forward the CalPERS audit notification and final audit report to the exclusive representative, if any, provide CalPERS and the exclusive representatives a list of the names and members affected by the final audit, and communicate to CalPERS that they have provided the CalPERS audit notification and final audit report to the exclusive representative. CalPERS team members are recommending the board adopt a support position on SB 1038 because we believe the bill will assist CalPERS to resolve open audit observations and improve collaboration between the employer and employee representatives throughout the audit resolution process. And with that, I'll stop and answer any questions.
Do we have any questions on this before we take a vote? You do? All right, Ms. Gallegos, go ahead.
So is this audit taking place by CalPERS or by the SCO? So I know SCO
This is
does
the
some.
CalPERS audit.
great.
Yes.
Thank you.
Am I correct in thinking these are the audits of the employers that may impact an employee, correct? And they have to pay money back or whatever, something like that. Okay. Any other questions? With that, what's the pleasure of the committee? It's an action item. I need to have a, yeah.
I move the staff recommendation.
Are you moving the staff recommendation? Second by Mr. Miller. I don't know who else said that. Sorry. Mr. Johnson, did you? Never mind. It was Troy. Second by Troy Johnson. All those in favor, please take a roll call vote.
David Miller,
Yes.
Deborah Gallegos, Michael DeToy, Monica Erickson, Troy Johnson,
Yes.
Fiona Ma,
Excused?
Lisa Middleton,
Aye.
Kevin Palke,
Aye.
Ramona Bacava,
Yes.
Yvonne Walker, Melissa Willett, Dr. Gail Willis.
Aye.
Okay, and Danny, did you just want to quick, I think this got pulled, did it not?
Correct. I mean, we're recommending, we're pulling the item. The bill was amended in Assembly Health yesterday to remove the provision that impacts CalPERS, so the bill no longer applies to us, so no reason to take a position.
No reason to take a vote. Okay, so I just wanted to make sure of that. Everybody, we can cross that off. However, I do have a caller on this. So if we could go ahead and hear the caller's concerns.
Yes, President Taylor, we have Amy Roberts here to speak to 8C. Amy Roberts, you are now live and can proceed with your comments.
Thank you very much. I'm a little bit nervous. I hope you'll bear with me. I appreciate being employed by an agency that utilizes CalPERS health insurance. And I was on my first diet at 7 years old. And so that is over 40 years of dieting. I've had weight loss surgery in the form of a lap band covered by Blue Shield of California before CalPERS was with Blue Shield of California. I used to be an auditor at a financial institution. This memo is very well written. And if I were a board member, I would vote to oppose the bill. I did not know it got pulled. However, I've also been on 2 of the 3 medications that are currently available through CalPERS, the phentermine and the Contrave. And guess what? Contrave has the exact same side effects as the reasons you state that Zepbound is being discontinued due to gastrointestinal effects. In 6.5 months of being a self-pay on Zepbound, I have lost just over 20% of my body weight. Diet and exercise does not take care of this chronic disease. While I have been disappointed in the World Health Organization for a variety of reasons over these more recent years, it has been recognized as a chronic disease. And we need to stop viewing it as, take the fork out of your mouth, Amy. Diet and exercise will take care of it. For some of us, that does not work. I maintained 80% of my weight loss from my 20-year-old weight loss surgery. My body stopped losing weight. I am a professional dieter. And I think CalPERS should look long and hard at covering these most up-to-date medications. We have more than 20 years of data on Mounjaro, the exact same medication as Zepbound. We do not have 1 year of data on Zepbound. We can make it look like we do, but we have much more. The Roux-en-Y bypass surgery brings the gut closer to the stomach. Many patients have their diabetes under control with bypass surgery prior to leaving the hospital. We are finally making great strides in the treatment of this chronic disease that late night hosts, who I adore, still make fun of us. And it's taken a lot of courage for me, even speak anonymously as a member of and someone who appreciates my health insurance benefits greatly. And I pay part of my health insurance benefits myself. And I'm currently a self-pay.
Ma'am,
Yes.
you have exceeded your 3 minutes.
Thank you very much.
Thank you so much. With that, we will move on to item 9A, state and federal legislative update. Mr. Brown?
Yes, good afternoon again. That's the state and federal update, and I do believe we'll have Dan and Karishma joining me for the federal update. I do see Dan, and hopefully Karishma will be up there soon. On the state side, summer recess is rapidly approaching, and the policy committee deadline for bills to pass out of their second house policy committee is July 2nd. After that deadline, the legislature will go on a 4-week summer recess, return on August 3rd, and then have to finish their business by the end of August. The governor will then have the whole month of September to sign or veto bills. Today, I want to provide a quick update on a few bills. First, the CalPERS sponsored bill, Senate Bill 939, which would simplify service credit payment options for service credit payment purchases elected after January 1st, 2028, passed unanimously out of Senate Assembly PERS Committee last week and is now headed to Assembly Appropriations. The next bill is AB 383 that makes several prospective changes to the compensation limit and safety formulas of PEPRA members. AB 1383 is slated to be heard in the Senate Labor, Public Employment, and Retirement Committee next week. Our updated cost analysis was finalized last week, and we have been distributing it to our stakeholders and interested parties. And then the final bill I want to mention is Assembly Bill 1619, brought forward by the Orange County Employees Retirement System to allow county retirement systems to increase the per diem for eligible board members to $320 per meeting. The Assembly PERS Committee felt this policy should be extended to CalPERS and CalSTRS board members. So the bill was amended to increase the compensation to attend CalPERS board and committee meetings from $100 to $320 per day for the 2 officials appointed by the governor, the person appointed by the legislature, and any retired elected member. This bill passed out of the Senate Labor, Public Employment, and Retirement Committee. It's being heard this morning. I anticipate it will be passed out, and then it will be head out to the Senate Appropriations. And with that, I'll move on to the federal update. First, I want to mention a few things before I turn it over to Dan and Karishma on the health side. Our Chief Health Director, Don Moles, participated in 2 separate meetings with the minority staff of the Senate Finance Committee as they look to develop their policy agenda for the next Congress. The first meeting focused on affordable and accessible coverage, and the second meeting was on lowering prescription drug costs. Dr. Moles discussed the provisions we were able to obtain in our health plan and PBM contracts to control costs and improve performance, as well as our continued concerns with anti-competition and healthcare consolidation. We will continue to engage with the Senate Finance Committee and will be responding to an RFI that they just put out yesterday around lowering drug cost. Next, I wanted to mention a comment letter submitted to CMS on their 2027 Hospital Inpatient Prospective Payment System proposed rule. In this annual rulemaking process, CalPERS writes in support of the proposed expansion and mandatory participation of the Comprehensive Joint Replacement Model expansion to all eligible acute care hospitals nationwide, which will better align reimbursements with episode-based care and quality outcomes. In addition, we are encouraged that CMS is considering site-neutral payment policies as they have the potential to lower healthcare costs, mitigate and deter vertical consolidation, and lower beneficiary cost-sharing obligations. And with that, I will turn it over to Dan and Karishma.
It's good to be with all of you today. We are in the midst of the last few weeks of these summer work periods before Congress leaves for its August recess. So the Congress is in for a couple weeks in June, and then following the 4th of July, we'll be in for a few weeks in July. And during this time, this is really the bulk of the opportunity to do the work of the congressional agenda before Congress leaves for the August recess, and we'll really start focusing in on the campaign season. The Congress is expected back in September for a few weeks, at which point there will be some work on federal funding issues, but we expect that to be pretty expedited, allowing folks to go back home and again, really work to campaign before November. So in the few weeks that we have, there are a few issues that are really taking up airtime, if you will, in terms of Congress. First, there are the ongoing issues related to federal funding that continue to take up interest, committee time, and leadership time, as well as things that are must-do, like FISA reauthorization, and also NDAA, which is an annual National Defense Authorization Act bill that gets done on a bipartisan, bicameral basis. So these are the must-do items: federal funding, NDAA, FISA, which is expired, that Congress must address at some point. So debate continues on those in various forms, with the hope that there will be some type of agreement before the August recess, but those negotiations continue forward. Additionally, on the issues on the financial services side, there are a few that are also ongoing from a congressional perspective, that are taking up the bulk of the energy. One is the issue of housing. There have been measures that are there has been interest and work being done on a bipartisan, bicameral basis on housing. But interestingly, the House and the Senate are in different positions. So the Senate is expected to take a procedural vote on housing legislation, and hopeful that at that point it will pass. And then there is revised text that will be expected to be passed by the House. But again, unclear how this all plays out, but these are the issues that are on the agenda that may see some progress or potentially could stall out. The other issue that has been a focus of Congress has been on digital assets, and those debates continue as well. So these are all what I would characterize as on the agenda, but not necessarily must do. So we may see some progress or we may see them stall out. This is all in that backdrop of planning for what comes next. There are various political configurations that are possible after the November election. And Democrats in particular on the House side and also on the Senate side are using this time for planning, to the extent that they do take over the gavels in one or both of those chambers, are thinking about what is the affirmative policy agenda, but also what are the areas of potential oversight. And we see that work, that planning work, that's really taking place behind the scenes as we work through the summer, and staff will continue some of that work into the fall while members are away. I will pause there. I wanted to give sort of those high-level comments from a general perspective, from an atmospheric perspective, and turn it over now to Dan, who's going to take us through what's happening over at the SEC and may have some comments on the general points as well.
Well, thank you, Karishma. We monitor all of the federal financial regulatory agencies on behalf of CalPERS, but I think it's safe to say that the vast majority of the issues we're currently confronting are before the SEC, which, is headed by Paul Adkins, who's an old friend. He's an institutionalist. He's not a MAGA Republican, so to speak. But he is very focused on trying to restore the number of initial public offerings. When I got out of law school in 1990, we had over 8,000 publicly traded companies in the country, and now we're below 4,000, and continuing to trend in that direction unless something is done. So he has set forth an ambitious agenda for rekindling IPOs that includes streamlining and rationalizing corporate disclosures. And he's put out a number of proposals in recent months, some of which we've already commented on, some of which we plan to comment on. But these include Regulation SK, which are the non-financial disclosures made by corporate management, the proposal to rescind the climate risk disclosure rule, proposal to move from quarterly reporting to at least allowing some companies to engage in semi-annual reporting, and reform to the 14A8 proxy voting process remains pending. Again, we have engaged in discussion, if not comment, on all of those issues, and will continue to do so. Interestingly, while the SEC rescinded the climate risk disclosure rule saying it exceeded the SEC's authority, in their comments in the proposal, they implicitly acknowledge that investors remain focused on additional sustainability disclosures, and he leaves open a pathway for market-based adoption of sustainability standards, which of course is exactly what we've seen in the U.S. Most of the large U.S. issuers adopted the recommendations of the Financial Stability Board Task Force on Climate-Related Risk Disclosures, or TCFD. Now a lot of those issuers are migrating their disclosures to ISSB. And while on the surface, rescinding the climate risk disclosure rule would seem to disadvantage ISSB filings, in fact, it's putting a premium on the importance of those disclosures, particularly for U.S. issuers that are trying to satisfy disclosure obligations in foreign jurisdictions, most notably the EU. So just to circle back to where Karishma left off, I've been consistently saying for the last year that the House election is the Democrats to lose. They very well are likely to be the majority, which would make California Congresswoman Maxine Waters chair of the House Financial Services Committee again. I think the Senate is more difficult to call, but it depends on the size of the wave. If there's a huge anti-Trump backlash that captures the Senate, it captures the House, that could very well carry some states like North Carolina, Maine, Texas, Ohio. In Ohio, former Senator Sherrod Brown, chairman of the Senate Banking Committee, is actually up in the polls. So it's well within the realm of possibilities that Democrats capture both the House and the Senate, in which case Karishma rightly notes that oversight is going to be a priority. Certainly there will be investigations of the Trump administration, and my bet is that they will impeach him. The only question is what they impeach him for, and whether they can get a conviction in the Senate. It seems unlikely, even if they can get Republicans to support impeachment, because that would have the effect of making J.D. Vance the incumbent with respect to 2028, and I don't think that's an outcome that Democrats desire. So there will be a lot of oversight activity, probably impeachment, but for the most part, Trump is likely to be there for the next 2.5 years, but in an increasingly lame duck capacity. We're starting to see that with Republicans starting to peel off their support. If Democrats capture the House, then I think there will no longer be the strong pressure to support the administration among Republicans. But let me pause there, and we're happy to take any questions.
Okay. So I do have public comment. Does the board have any questions? I'm not seeing any questions from the board. I want to thank you both for your presentations. None of it sounds good, or great, I should say. But thank you very much. With that, we're going to move on to 9C, which is, let me make sure I'm on 9C, public comment. I have JJ Jelinczyk and Martha Penry. If you want to come down. You're on.
Oh, thank you. Thank you, President Taylor, and to the board. I just had a quick comment I wanted to share with you. I guess yesterday there was some conversation and a presentation about the member service center, the call center. Unfortunately, I wasn't able to attend yesterday, but I want to share some wonderful personal experience. While not everybody may agree, I am just so completely thrilled, and just don't have enough kind words to say about the call center. Life changes happen, right? And so after seeing my tax man, He said, you know, you got to do this, you got to do this, start here, bump this up, bump that up. I started working with the pension I received from my husband. That was like an act of Congress. I thought for sure they were going to ask for my blood next. But I got that done. I called CalPERS. They answered right away. It was mid-morning. I said, this is what I need to do. And the gentleman, and I apologize, I didn't bring his name today. I wrote it down so I would have it. He said, let me help you. And so he said, you can do it yourself online. I can walk you through it. I can help you. What do you want to do? I said, let me try it online because I'm still learning. So he said, okay, got a pencil? Yep. He said, okay, do this. There's a drop down, click on that, do this. He said, if you have any trouble whatsoever, then call back and we'll walk you through it. We'll help you. In a matter of minutes, I was done. Completely got everything done. Everything was just perfect. By the time I got off of my CalPERS, I actually had an email saying confirming everything I had done. I could not be more pleased, and I just want to thank Kim Malm and all of the hard work of that call center, just amazing. So I just wanted to let all of you know how pleased I am, and thank you.
Thank you, Ms. Penry. We really appreciate that.
You bet.
JJ Jelensik, RPEA, for the last time until next month. I was going to give each of you a copy of this report. However, the system has already put out a statement that this report is not based on fact. It is an opinion piece full of baseless assertions and breathless language, so obviously there is no need to. It is not a fact, as stated in the report, but rather a baseless opinion that your CEO has only a high school diploma. It is not a fact, as stated in the report, but rather a baseless assertion that Marcy Frost said even before the first PRA request, CalPERS is not sharing the limited partnership agreements. CalPERS is not sharing any side letter. The CNBC clip showing that she said that must be a deep fake. It is not a fact, as the report states, but rather a baseless assertion that this very transparent system withholds lots of relevant information. This PRA request verifies that. It is not a fact, as the report states, but a baseless assertion. The CalPERS routinely denies public record requests on the basis that, quote, the public interest in disclosure is clearly outweighed by the public interest in non-disclosure. I've gotten that response dozens of times. Silly me, I didn't realize it was a typo, although CalPERS didn't, in fact, provide the information. It is not a fact, as the report states, but a baseless assertion that public pension plans are not covered by the Employee Retirement Security Act, ERISA. It is not a fact, as the report states, but a baseless assertion that members of the board lack investment experience and expertise, and that none is required for election or appointment to the board. It is not a fact, as the report states, but a baseless assertion that the governor of California earns approximately $234,000 annually, but dozens of CalPERS employees earn multiples of that. I have many baseless assertions, but little time. I would encourage you to support the creation of an Office of Inspector General. Such an office could help separate facts from baseless assertions. If you want to read a copy of the report, even though it's not fact-based, you can download a copy from the RPA website. You can buy it on Amazon, and I have reason to believe you could actually check it out from the state library. Thank you for your attention.
Thank you, Mr. Jelensik. Thank you, Ms. Penry. with that, it did skip summary of board direction.
I did notice that, but I recorded none other than through committee direction.
Okay, great. With that, hold on a second. We will adjourn now into closed session for items 1 through 3 from the closed session agenda. This will include the following litigation matter: Granada v. CalPERS, Eastern District of California, case number 2:21-CV-01256. We will also receive the General Counsel's update on pending litigation. After the closed session, the board will reconvene in open session. I want to thank everybody, and hopefully you all can make it to our offsite in Monterey. We will see you in July. Oh, wait. There you go. We are officially adjourned. Well, recessed. I'm sorry. All right then, so we welcome back to open session. We have nothing to report from closed session. So with that, I will adjourn our open session Board of Administration meeting for this month and look forward to seeing everybody in January in Monterey. I'm sorry, July.
That's a good idea too, though.
We used to have it in January. Yeah.